Hello. Welcome, James.
Hey, there he is.
So Mo's gonna be a little bit late for a couple minutes, so we're just gonna do some chit chat before he joins.
Sounds good.
How's your day?
Kind of hectic, right?
Right,
on-
yeah. That was an understatement.
I had a lot of trading to do this morning and rebalancing of the book, so
hmm
was frantic there for a little bit.
hmm So what is the sectors that you coverage?
So I'm a techie. So my background is in building startup companies in Silicon Valley and venture capital, and
Mhm.
so I cover the cloud companies, semis, software, SaaS, you name it, pretty much like in the IT and tech side, IT infrastructure. That's kind of
Okay,
my home zone.
perfect. So I think Barnaby is gonna join us soon. He'll have quite a lot to talk to you about that. Oh, here we go.
Yeah, he was on a second ago, I thought.
Yeah, Barnaby's back. Yeah.
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 Yeah, we've been chatting quite a bit. I was interning
Mhm.
under Barnaby back last quarter. So
Mm,
Yeah,
okay. So that was before I come here.
top intern, I would say.
top
Ooh,
intern. Ooh.
here we go. Yeah. I mean, it hits also pretty hard for me today. But being like long short, so go ahead. Yeah, fan. What's up?
No, nothing. I'm just saying, like, intern is kind of like you're like James, kind of like overqualified as an intern.
Yeah, exactly. That's what I.
Yeah, but I'm not ashamed to take any steps I need to. I'll learn anything, you know. I'll sweep the floor if I have to.
Yeah, I'm really excited for you to like really dig into Mo's style. I think you'll be very good.
I'm excited too. I've spent the last 6 weeks or so just like organizing an entire uh, tracking system so I could be really systematic and really try to apply it this season. So I'm going to be publishing a lot of that research as well, just to our community here, Wahdy and friends.
Cool.
Yeah, I wonder if
Yeah.
like Mo's gonna like let you join like the research team, like chat.
Good question. Mo and I are talking about doing a podcast also. That's on the menu.
Yeah,
Oh, okay.
cool.
Yeah, because like I know like we chat a lot in the Bex like Valve chat, but it'd be like interesting if you can chat over here as well.
Well, let's see where we land. I ended up 20 basis points today. I'll take that as a win.
Yeah, that's
Nice.
certainly a win.
Holy crap.
Yeah.
which
I
is
mean, in
kind
my
of
space, it's like everything's down. So, being long short, doesn't hurt too much.
Yeah, I'm long short also and increasingly so, but I am glad that I rehedged yesterday and kind of rolled up
Mm.
all my gamma exposure so that I was kind of tight, kind of snug, you know.
Mm.
And I am glad about that.
do you still have your momentum book on or
I do, but it's usually flat by the end of the day.
I see.
And that book has been kind of miserable lately just because volatility has been so low.
Or it's coming back up to 14.
It's coming.
I mean, last time we had was around the FOMC event, right? Like back in May.
Yeah, we haven't I only resurrected that book first. I mean, it felt like 1999 or I don't know, 98 or something again, where these stocks would just go nuts all day, on some event. And I had a friend who started an event-driven momentum fund that lasted like 4 months, and but he was up 50% each month for those 4 months. So he's and then not so much in the final month, but yeah, volatility has come, back out of the teens, and it's just now it's like 2006 again. Ugh.
Yeah, so we did make the comparisons, like whether we look back to 99 or like 08 or like 18, and we think it's kind of similar to the 06 vibes. And hopefully Fed doesn't make a mistake this time.
Yeah, I mean, today's 3% move in the Nas. I mean, we haven't seen something like that in a while, right? I mean, it's been
Right, I think since December 2022.
Yeah, that's I was already, I don't know if you guys read my stuff, but I was already kind of like starting to get a little bit bearish and stay bearish. And so I feel really good that this is playing out the way that I kind of thought. I just really didn't think we'd start to see a lot of selling before there's a rate cut. But I think now that it's priced in, basically the rate, the market's treating it like the rate cut has happened.
Yeah.
We hit what, like 100% odds, what, in the fall now?
I think we are.
Let me see.
Wait, the latest were. Yeah, I know.
see,
I
like,
think
we're
you have the more fancy system
No,
there.
I don't have the more fancy thing, but
No, on Bloomberg it's like 99% priced in for SAP, and for the full year, yeah, 2.5.
I'm just looking at like how 10-year is moving past week or past month. 10-year is like down 15 bips or so.
I think 2 weeks ago we are like
2 year.
2/10 is like 4.6 and 4.2, and now we're at 4.4 and 4.15.
Yeah,
So.
like 2 year is almost like 25 basis points. Like compared to 1 month ago. So if you use that as like a proxy, yeah, so like Jamie's kind of like correct. Like market is like already priced in like one cut, judging from like the how 2 year moved compared to like 1 month ago.
Yeah. So I think that that's gonna be a bigger cut when it comes. And I don't know,
Yeah,
it looks
but
like
I mean, like,
cooling.
yeah, I mean, honestly, like today just seems like a. I mean, I'm reading something, but like maybe it's like Trump induced like panic, and like TSMC kind of like down 8%, kind of like triggered like a semi sell-off. But
Right. I mean, it's almost like we had this discussion for a while, right? Or like weak economic outlook, and I don't think the majority out there is gonna sell because the chart looks aggressive or multiples extended too much. Like they need a reason to sell. I guess like over the weekend, it kind of just gave people that reason, and now VIX is up. So.
Yeah, I mean,
yeah, today
what do
is
we, what
like VIX expiration though. Like the July futures are rolled over to August. I think it's just today. So there might be some like position like related or like rollover related move. So I mean, it's interesting to see tomorrow if we get like a continuation or kind of like people are still buying the dip. We'll see.
Oh, I mean, on one hand, right, we do have 6 trillion in money market funds still. So I think that's something to watch whether people will move in. And I like the narrative kind of shift now, like to buy the dip, right? So like a week before when I was looking at this, I was like, like maybe there will be like a FOMO and we have a melt up. So that was a view I had like I think a week ago where it's like it could go both ways, really quickly. But yeah, maybe I would say pay attention to money market funds to see where the fund goes, and that's a liquidity driven move, rather than a like fundamental.
I'm just catching up on everything. I got in like 3 a.m. in Vegas last night, so I've wasted half the day like trying to catch up on everything. And yeah, I'm just looking at the continued strength in financials and insurance. Progressive had a good quarter. What else happened? GitLab's getting acquired. Maybe that's the rumor, which I consider to be garbage.
Wait, is that Google, by the way?
Why? Datadog.
GitLab?
Yeah.
I don't know. They mentioned the acquirer.
It's
I was like,
Datadog.
I know Google's buying Wiz.
oh yeah. It could be that. Yeah.
That's a big
Yeah.
one.
I
That's
mean,
the fastest growing enterprise startup ever, Wiz.
I see.
I got a bunch of friends there who are about to be pretty wealthy, I think, again.
Right.
Again. Like they
Again.
already. Okay.
Yeah, some of them need it though. They had a couple of rough patches, so one of them needs it really bad. So I'm really glad for them.
Good stuff. Good stuff. Gonna have another wave of nice, Silicon Valley housing market because of this. Palo Alto up again, maybe. Who knows? Yeah.
I mean, we'll see. Remember that bumper sticker my karma ran over my dogma from like the 90s. I feel like that. My beta ran over my everything. So I think like if this thing is down, it's down, right? So these guys are getting screwed on their acquisition because their share post to be underwater, and I'll probably have some retention or clawback, So that sucks to like get acquired and be immediately underwater on the conversion. Hopefully they got some kind of drag in the conversion. I don't know. I don't have any details on the transaction at all. I'm being very tight-lipped about it. I'm just annoyed because I was trying to buy Wiz shares on the secondary market and I couldn't find any. Nobody was selling.
What A did you say the acquisition of? Oh, I've forgotten.
Wiz.
GitLab. Sorry, was trash.
Oh, GitLab. Yeah, GitLab that's rumored. I don't think it's confirmed. But I know the stock was up like 3x volume today, almost 10% on that rumor. And I kind of think it's probably true. Let's see.
Datadog's down 7.3 today on that.
I think the rumor source is that they hired a broker. Yeah, so they're shopping the company.
Well, what percentage of these end up in something? I think it's
usually when they leak something like this, they've got a transaction contemplated. Okay, I got another source says the rumor is Datadog. I kind of doubt that though.
Hey Mo.
Oh, hello.
Yeah. Hey, can you guys hear me?
Oh, you
Hey.
got a new
Yeah.
hairstyle.
Hey, James, you made it.
I made it. I'm here. Thanks for inviting
How's
me.
Vegas?
It is hot and steamy. Kind of humid for Vegas, which means like, I don't know, 15% humidity or something. But it's hot out there. I've been up here
Well,
reading
I'm
all day, just in the room.
Blasting up the AC, huh?
I wish. This thing is a fucking joke. It's we don't like high roller stuff, hotels and stuff in the city anymore. So we're in like the Luxor, which is she's seen better days. Luxor's like the girl you go home with, but when you wake up the next day, she doesn't look as good in the daylight.
Yeah.
She looks real good at night, though.
I guess that goes for a lot of things.
Yeah, Vegas is
All
not
right.
crowded though. There's nothing going on.
Well, it's super hot. I heard that the sphere was melting.
Was it? But
It was a headline somewhere.
yeah, I've still not gone. Isn't that depressing? I haven't gone to the sphere yet.
All right. Hello, hello. Can you guys hear me?
Yeah,
Hey,
now,
Phil.
yeah.
Yeah, my mic keeps like disconnecting. So I'll kind of like keep this quick. So probably I'll just like just quickly walk through like the macro stuff. I mean, like today, just like the moves are all in the tech. I think, I mean, just like the news I'm kind of like getting is because Trump is asking Taiwan to kind of like pay protection fee, kind of like it's like a mafia style. Like if you want us to protect you, you need to like pay us. So kind of like the TSMC kind of like got affected by this news. I think I just checked the like the close. I think it's like down 8%. I mean compared to like the index, like the Nasdaq 100 index is down like almost 3%. So like the semi got kind of like smashed today. Yeah, but like other than that, like today is also like the VIX expiration. I think the July VIX futures are gonna roll over to August. I think the rollover is finished today, so whatever like moving the VIX complex, that's probably like that rollover kind of like has like a bigger impact. So I'm curious like to see if like tomorrow the this like down move have like any continuation. Is this like really like a people are like starting to kind of look like panicky, or it's just like positioning related move? Interestingly, like the in the FX world, the safe haven currency got some bids. I think both yen and Swiss they got bid today. Like the dollar Swiss and like dollar yen, like both are like down over like 1%. So like I think that's kind of like interesting. Like everything seems to be it seems like a risk off. I don't I like this nomination now, but it's like very like typical risk off move. Like the bond market is kind of like quiet. 2 years like down 0.7 bips at 4.438. 10 years like down 0.8 bips at like 4.159. So like not really like a lot change on there. Atlanta GDP now went to 2.7% today after like a strong retail sales. And I think today's like industrial production number, like at least like the headline number is pretty strong. So I think that's kind of like due to like the now casting feature is just kind of like pull the GDP now figure up. I think like 1 week ago we're still looking at like a 1.5 GDP now figure from like Atlanta Fed. Like today we're like already at 2.7%. So very interesting. Like on the cut probability side, I think the July cut is like the probability got diminished. I mean, even though like on Monday, the Goldman Sachs says like, oh, okay, like probably like we're already like prepared for like a July cut, that kind of like triggers some like silver buying and kind of like boosted the cut probability to like almost like 12%, but like now it's only 3%. I think December cuts, that doesn't really change too much. So it's still like it's like 2.5 cuts. Yeah. So yeah, basically just like the housing starts numbers today and also like the industrial production. I think one thing that's like worth mentioning in the housing starts is the like the single family housing like start is like slowing down. Like although like the headline number is like not that bad, but I think that's due to like a more volatile component from the multifamily home. But like I think the single family slowdown kind of like is like more important. It's almost like you kind of like strip out the like the food and energy component from the CPI. I mean, that's kind of like a analogy, but you get what I mean. So like it's just like the core component is like slowing down, which is like probably like pointing to like further slowdown in GDP. So yeah, I think that's probably all of it. I mean, tomorrow, I think the third plenum in China is finished. I think we'll probably like get to see if China is gonna put out like some more, if they're gonna put out like some more demand-driven like policy. Because I kind of like talked to some like people in China like yesterday. So like I think the core issue like right now is like the people doesn't really have like enough like spendable income. That's like one of like the crux of like the current issue. I mean the CCP is kind of like is still like working on the supply side and doing some like tax reform relating to like demand side, but like nothing like directly demand side. So we'll see like if the third plenum kind of like change the direction of like this policy. Yeah. But yeah, it's just like I think like when Trump's like getting more active, there's like more like macro volatility as well as like geopolitical like volatility. So yeah, like just turbulence time ahead. Yeah, I think that's just like my kind of like summary. Yeah.
Oh, that's really good overview. Thanks for that, Yafeng. What about you guys? Actually, before we really have a discussion, James, did I get a chance to introduce you to Andy, Yafeng, and Barnaby?
I don't know that I've been fully introduced or they knew I was coming, but yeah, I haven't been introduced, but I did say hello.
Oh, we got the heads up.
Yeah, I sent out a message letting them know that you were going to be on.
Okay.
But let me just do like a basic intro for everyone, and then you guys can add on to it. But
Sure. Yeah.
Andy, he actually also based in the Bay. I think it's us four are kind of based in the Bay, and then Barnaby's based in the UK. But you know Barnaby because
Mhm.
he was running
Yeah.
the program. So Andy was a sales trader at Citibank. Did a rotation across FX rates and equity derivatives. So really smart guy. He's now laser focused on learning the long short equity business. And so this year he started covering EVs and has done a really phenomenal job. So just a really smart kind of guy to kind of run ideas by. Yefeng, you probably know him from the other chat that we're in. Super smart guy, learning the macro side of the business. I guess he was just getting bored in a PhD program, so he decided to to do something that was more fun, right? Um, I'm sure he doesn't need that much of an introduction because you guys have chatted before, but
Yeah.
just a really good brings a really good perspective from macro. Interestingly enough, like when we were first chatting, and you could probably speak to this a bit more, but and he was like, oh, he wants to learn. Whenever I talk to him, I'm like, he knows a lot, so I think it's just getting more practice and going through the motions, but just a super smart guy to bounce ideas by as well. And then Barnaby, our token Englishman, um, he's based in the UK. Well, actually, I met him when he was working in China, actually through a mutual friend. But he's always been interested in the markets, and now he's finishing up a master's program. Also has been covering the software side, as I'm sure you know. So just kind of a good group to kind of bounce ideas by. We will often have Gene, who often comes on as well. He's a nuclear engineer that is also interested in markets. Brings a good perspective from that angle, and then we'll occasionally have some like interns from the actual program that will hop in on the call as well. The two primary ones are Hunter and Robbie, and if you hop on or if you come on these, if you're coming on, pretty much you'll probably run into them a couple of times. So that's kind of like a brief overview, but any of you guys want to chime in and add to that?
think that's very comprehensive.
Awesome. Great to meet all you guys.
Yeah, good to meet
I'm
you
excited.
as well. I probably need to buy a camera now we have more people on. I feel bad.
Yeah, I always
yeah.
turn the camera on just, because it's good to get FaceTime.
Right.
We're so far apart.
I don't have one on my desktop, so I need to sort that out on maybe Prime Day. Help out the Amazon top line.
Yeah, we'll figure that out. It's something really quickly. So, let's go ahead and do and kind of dig into what Yafeng was saying. So, one of the things, about, I mean, the narrative that we've been talking about has just been like how equity positioning is overextended, and that, the markets were kind of set up for a weaker second half of the month. I think that's just kind of coming to bear. The other day we had a deep conversation about whether or not this was the Trump trade, and I think I laid out my argument that it's not the Trump trade, because a Trump trade would see a bear steepening of the curve. We're not seeing that. We're seeing a bull steepening, so or a bull kind of inverting, actually, or flattening. So in this dynamic, that's really more reflective of a cooling outlook, like the underlying theme has been that, since about, the middle of this, well, a couple of months ago, I think, in March and then again in April, economic surprises have moved dramatically lower, right? So we've now been in a period where there's been a couple of months of successive economic estimate misses. And so that dynamic typically precedes economic revision. So, like, if you think of, major economists on the street, or even equity research analysts, or, hedge fund PMs, or bond PMs, right? They're all trying to understand where the economy is going, and they want to match their portfolio roughly to, what the best regime is in their, in their books. And so right now, what we're kind of seeing is the data has come in really soft. At the same time, the Fed is not as hawkish as people, or it's not as dovish as people anticipate. And so I think that, ultimately was like my thesis for why we were set up for a surprise in the second half of this month. I've been, you know, James, you can talk to these guys, but we've been talking about this like for the past couple of weeks, and so it's interesting that it's finally kind of picking off. Now, what is a catalyst for it? Like I said, there are air pockets of volume because you have that seasonal like the normal seasonality, and then we're in like a blackout period for many corporates, so you don't have that buyback demand. So if you remove that buyback demand, and if the marginal positioning is going to be a little softer, you're just not going to have as much, say, demand flow. At the same time, the selling pressure, for say global macro PMs, these guys will be thinking about how the broader economy is probably starting to roll over. And in that case, they're going to position primarily across like, just selling short the S&P or the NASDAQ. And so I think this is the dynamic that we're seeing at play. We spoke yesterday about the Russell S&P spread dynamic and how, that'll roll out. I won't be surprised to see it on the news, and we'll probably see a couple of Bloomberg articles by the end of this or next week discussing that as well. But they all speak primarily to like a weak positioning backdrop, like an over and extended positioning posture by the market, a weak flow dynamic, and when you have like a lower, say, flow or say volume dynamic, any small thing can trigger, a bit of a sell off. What kind of drove the market higher was this like thinner print, and now it's the same thing that's going to drive things lower. Between it, informational events, you should get some mean reversion. I think for sure, if you look at what happened this or the other day with, Trump talking about maybe that Taiwan needs to arm itself, how that might, shift risk sentiment around Taiwanese companies, and ultimately that's like flowing into the semiconductor and AI value chain. Um, I think one of the guys in one of the the Bloomberg chats that I'm on was saying how this is kind of like back in during Trump's first presidency, you kind of bought the rumor, sold the news kind of a thing, and that seems to be the same trade. So, kind of expect a little bit of mean reversion, in that. But nonetheless, these comments can spark some additional volatility. So you add on those little sparks of vol, or sparks of information on top of an already extended position dynamic, and I wouldn't be surprised. I'm expecting more of this to happen. It's not gonna have the same. Tomorrow it's going to be a different story, but the result is going to be the same, which is this extended equity positioning needs to get back in line. Equity markets are trading as stuff the yield curve is steepened. It's not. So that needs to come back. And my expectation is through earnings season, the first couple of weeks of earnings season, we'll get the information that will allow the markets to come down a bit. And then also, depending on how people are postured into the FOMC meeting, we're a little too early to really say how that's what's going to happen post FOMC. But right now, the dynamic is, there's an expectation that there will be a shift, in the way that the Fed is communicating its strategy. I think that that's something that's probably, we'd want to fade, just because the Fed, Jay Powell, and even more recent, Fed speak has been more, hawkish in the details. For example, the discussion about quantitative tightening, maintaining that, and so on and so forth. So that's the kind of like backdrop that I think that we're dealing with. So yeah, it's kind of my take on the situation. James, Andy, Barnaby, you guys have any comments?
Yeah, I think I kind of agree on the general theme that we are talking about here. One thing, I don't know if you guys noticed, Biden tested positive for COVID-19, and
Excuse me.
Biden.
Oh, I see.
And I know he was talking about, he might back down if there's a health issue. I don't know if this is like nudging towards that message or not. Just something to keep on the radar. And yeah, I did want to add something on the industrial production today that mentioned by Yafan. So yeah, headline, 0.6%, beat the consensus of 0.3. But if we look under the hood, because I'm covering the EV sector, I noticed something really weird happening for the motor vehicle sector. So the annualized number for the motor vehicle on the assembly line went up to 13.09 million, and that's like 3 million increase month over month. And this is the highest level in the past 9 years. And if you look at the composition of the whole thing, you realize that this is what's caused the move up 0.6%, like causing the beat on the headline. So underneath, without this, it's going to be pretty weak. I would say it'll almost like, I would say, close to the consensus number. So I'll keep an eye on this, because this is something that's out of the current narrative, because we are being talking about, auto, layoffs, and, generally the auto sector is weaker, especially on the legacy OEM side. I kind of didn't know like where this came from. It's kind of out of the blue. So I'll need to keep an eye on this and see what the management are talking about the production this year, because like it's like middle of the year, June. We're not even in the model year cycle yet. That's later in the year. So it's a really weird time to have that data print. But
Okay.
like, yeah.
Well, let me just jump in here really quickly, okay?
Yeah.
So,
Mhm.
so I saw your note this morning. Great
Mhm.
coverage on that, by the way. And if you think about what's happening, right? The dynamic, the big increase in autos was in light trucks, right?
Yeah, in light trucks.
Yeah. So, like, what's ramping right now?
Like, what do you mean? Like, what's
I mean, so if you think about like the product cycles right now, I think like that's where we're gonna want to like look at, right? What's the product cycles that are pushing this like big surge in light truck assembly?
light truck also includes like SUV and CUVs, like including the notes, right? But like it's kind of crazy how we have like 3 millions more than like annualized rate than in Q2. Oh, sorry,
Right.
in May, so the month of March, and it could be that the US is shifting its product mix from more like smaller hybrid or like electric cars into these more heavier SUVs and CUVs. It could be the reason. But it's just the timing is a little bit odd because the model year kind of normally happens in the later half of the year when they do the ramp up. So I was like, is this like a pull ahead of the production?
Well, so I guess my question is, if you look at, so like the answer to this question will actually be in the guidance that the companies report, gave at last quarter. They would have given some suggestion about whether there was some sort of a ramp or not. So I would, that's where I would go to see, what what the clues are here. My hunch is, so that first of all, like the number, the auto number they gave was the seasonally adjusted annualized rate, right?
Yes.
But it's the 1 month.
It's the 1 month. Yeah, correct.
So the actual 1 month, do we know what was that number? What was the actual 1 month number?
I actually I don't think the Fed gave us that number. But you mean like the actual production number for the?
Yeah, the actual production number, right?
I probably need to check other sources.
This will be something, I'll take a look at this too.
This is
but,
like a research I need to do.
Research task, yeah.
Let me jot this down.
So sometimes you can get because what they're going to do is there's a couple of things, right? On a non-seasonal basis, on an NSA basis, the number could be lower, but just by less than it would be on a, seasonally.
Okay.
And so, and that could create that distortion. So it'll be important to like know that, and then also to get to like what is the actual net change, because let me put it this way, okay? Like this is what can happen. If there was like, if Tesla started production of Cybertruck at one of the factories, or like increased the shift, a change that sometimes that small could lead to like a really big annualized rate change.
I see. It's because it's adjusted seasonally, like seasonally adjusted.
It's seasonally adjusted, and then it's applied to get to some annualized rate. Yeah.
I see. Okay.
So that'll be
something
to that'll be something to just kind of like dig into to see. But on the flip side of this, so what would drive auto OEMs to increase production? Well, one, if they were betting on lower interest rates, okay, because then they would say, well, total cost of auto ownership is going to drop, so let's increase production. Now that's an inventory risk, right? Because now they're going to carry a larger inventory into a weaker demand environment.
Yeah.
Ultimately, what's the headwind? An ASP impact, right? Like that's ultimately what it's gonna reflect. Which means, to your point, more goods disinflation still in the pipeline.
Right.
Yeah. So that's one thing. So that would be like if they were making an interest rate bet, and they would probably say something along those lines when they gave guidance or gave like their outlook on what they were expecting for either the rest of the year or the way that they're like posturing or positioning. I'll double check through my expert networks to see if there's any commentary on a ramp. But another thing that can happen too is you could have gotten like a factory update or a new shift. Sometimes these small things, they end up having a bigger impact, and we'll want to take a look at take a look at that.
Got it. Okay.
Yeah.
Sounds good.
Good sleuthing on that.
All right. I was actually building a like a tracking list for all of the indicators. Like the leading ones, concurrent ones, and lagging ones. So I'm trying to build that schedule out because I do see how tons of like macro data is is impacting the stocks. Like sometimes there's no ideal reason, it's all macro. And I'm just building out that and then picking up my Bloomberg tickers, or like, the index functions, whatever, and trying to make a list. And hopefully I can track these numbers better. Yeah.
Good. Yeah, no, that's another good resource. I'll find it for you, but JP Morgan, their analysts will put out like a macro heat map for their verticals.
Okay.
The only one that I pay attention to is the software one, but I'll look to see if they have an auto one and I'll send it your way so that way you can take a look and see the stuff that they're compiling, because that'll
Okay.
speed up your time, right?
Sounds good. Yeah. And then you know what, the industrial production commentary today from the sales side of Bloomberg, very few people mentioned about the auto sector. I guess, like, unless you are like watching this like a hawk, it's probably harder to pick up.
Right. I think in general people dismiss industrial production, the headline figure, just
Yeah.
because they feel like isms gives them that data point. But the capacity utilization I found is pretty useful. And then obviously it depends, like, all of these things, it's like the headline number, you're not really going to learn a lot about the economy from the headline number, but if you have a specific question and then you go look at their tables, then you can find some sort of an answer. So that's the way that I typically approach it.
Exactly. Okay. Yeah, that's on the macro side. I'll let Yefeng chime in on his
Just
thoughts.
a quick question. Like, how many heat maps are there? Like, is there like a macro heat map for like every sector, or it's just?
So pretty much every analyst will come up with a sector or an industry heat map that they think is important. And it's if the analyst has been there a long time, then they've seen a lot of things and hopefully their heat map is pretty good. But it's not, these are not necessarily things that are like so like life changing, in within Bloomberg or say Refinitiv, right? You're already going to have that functionality. And so do you really need to recreate it on Excel? Not if you just need to look at it, but it's helpful if you do it on Excel if you want to, like, if you want to like do something with the data. But even then, it's not that, I want to like put a really, heavy grain of salt there. What's going to happen is that you're going to realize that what's more important than you having a dashboard is that you have fluency. So that way, like, okay, if there's a number like in industrial production, what's the breakdown of components? And then how are those breakdown of components tied to a vertical? And where can I get the information about like the vertical, right? So like industrial production should be a lagging indicator of the guidance that was already given the month before. So no one is, like, if there's a big surprise, yeah, that's going to move the market a little, but generally speaking, you already kind of, I don't want to say that you already know what you think is going to happen, but you pretty much already have a view of what you think industrial production is going to look like over the next couple of months, because you have information about like the big things that drive business cycles, like interest rates, like growth dynamics, and then the IDEO story from that management gives you on their in their earnings calls. So with those three, you can go and do stuff. So I really recommend that, like the dashboard. I have spent so many hours, probably weeks worth of hours, building dashboards. I have all these Excel files. Some of them I haven't opened in 5+ years. So I think that, it's what really matters is fluency of the indicator. And you're gonna get that fluency by doing it, right? It's just like when you go through, on the equity side. If you go through a 10K, it doesn't matter that well, I don't want to dismiss it so much, but it's not that important for you to read a 10K front to back. What's more important is that you're fluent on like where to go in the 10K for a bit of information that you need. That's the same thing that applies for macro. So if you're going to do a dashboard, I recommend having just like the primary indicators, and so that would be stuff like, isms, Amphib, maybe the Fed surveys, interest rates, measures of like credit, so on and so forth, measures of like growth, so like say retail sales, um, and just like keep it simple. Like I would say almost like force yourself to just like track no more than say like 10 variables or something like that, because that's going to force you to make like a really good selected decision. And then from there, like, there's nothing wrong with you having like a worksheet or a monitor. That's like the equivalent of a worksheet on Refinitiv, where you have all these tickers listed. And every time you find a new economic indicator, definitely add it to that master list. But there's no need to go and build like an individual dashboard, because you're just not going to be going through all of that all the time. And the thing is that all of these data points, their importance is time varying. So, it's almost, it would be a waste of time to like go through all of the stuff every single time. Instead, it's much better to be fluent. And so that way, when you come to, a tricky situation or a question, what path to go down. So not, definitely, build that, macro dashboard, but try to keep it more limited. And then what I would say, especially for you, Andy, because the IDEO side for you really is on the guidance commentary. The surveillance that you do around that is going to be way more valuable than the macro variables.
Okay.
Way more valuable.
Yeah.
Cool.
Understood. Yeah.
James, what did you think about the markets recently? I think I saw that you mentioned that you were pretty well hedged. So congrats on that.
Yeah, so my last, you can read this on my blog, by the way, but my last point of view out of the macro data was that I was seeing a potential contraction in GDP across the board globally, and I was actually expecting that the prior month. Okay, and instead what we had was a surge. So that was kind of a mystery, and a mystery that I haven't fully untangled, but I think it's mostly some seasonal effects. But I did get the pullback I'm anticipating, and so my positioning has been market neutral to slightly short, and my intention is for this earnings cycle to be looking for primarily surprises to the downside. So I'm expecting a bit of a contraction here. The market has moved faster than I anticipated. Certainly, I was blindsided by the pop in small caps, and frankly, I wasn't really paying much attention to small caps either. So, in fairness, but apparently Druckenmiller was, because he had like a boat of calls. I don't know if you saw that in the 13F, which I'm sure are gone now. But so on the macro side, what triggered my attention 2 months ago was the decline in consumer sentiment, and starting to decline in consumer sentiment, as well as the relative rate of change of the PMIs have been declining for about 4 months. And the number of industries reporting growth had peaked, so we were at 70, 60, 75% of industries reporting growth. And, the PMIs tend to peak around that level, although currently in July, that was 100%. The other thing I pay a lot of attention to from like my compass bearings, and just to echo what you were just saying, like the way that I look at this is trying to plot the direction of the wind and currents, what are the tailwinds, what are the headwinds, how do I want to position the boat, if you will, to sail, and then looking for opportunities within that. So the other thing, of course, I look at as inflation, and then every single leading indicator of inflation that I look at, in particular things like price input output costs in the PMIs, some screen scrapers that I run on Amazon and other e-commerce sites, suggest that inflation is up across the board. So it's not under control. As far as I'm concerned, that narrative is bunk. And until there's a significant contraction in GDP, that's probably the case, right? So it looks like that's happening. So my outlook has been like slightly stagflationary, and positioning accordingly would be market neutral to slightly short. I'm very glad that I took that positioning, and I took my net long exposure off, prior to this downturn, and I've been neutral. And so I was up slightly on the day today. As you guys know, I think I'm like basically very heavy in tech or tech related, basically anywhere that tech is like transforming a existing industry or is a pure play tech. That's something that I'm usually looking at. So anyway, that's my 2 cents on it. I don't claim the macro casting kung fu of you, Wahdy, but that's my glance at it. And then anecdotally, so I spent last week at VentureBeat's Transform conference, and I spoke to probably 150 people across 3 days. And when I say spoke to, I mean not hi, how are you, but like in depth. So I spent all day that I wasn't on stage or hosting roundtables talking to people, which is why my voice is still almost gone. And so in the AI sector, my general takeaway is that within the enterprise, AI is not moving anywhere near as fast as everyone expects or hopes. Okay, so we're still very much at like the infrastructure deployment phase. Like it reminds me actually like of the early internet days, like when everyone was like, how do I connect to the internet, and how do I build a website, and how do I do this and how do that. So it's like at that stage. So we haven't seen anything yet with regard to uptake in the enterprise. I think the uptake that exists today is all like consumer tools, so the chat GPTs and the Microsoft um, uh, coding assistants, and to a limited degree Gemini. So I don't think the enterprise AI stuff comes until next year, and there's a bunch of infrastructure barriers between here and then, and also in terms of problems that people are experiencing. Hallucinations are still number one. That's still like the number one thing that's stopping model adoption, and there aren't any really great solutions to that yet. So all of these companies that I talk to are looking at building RAG pipelines. If you know what that is, that's retrieval augmented generation, together with like top-end model filtering capabilities through through the cloud solutions. So right now it looks like the cloud companies are going to win again, like just by default. Like everything goes to the public clouds. They're going to have the purchase pipeline and tooling and everything set. And I still think that Amazon, even though Amazon doesn't look like it's ahead right now, with their $4 billion investment in Claude and Anthropic, I think by this time next year, Amazon will be the premier enterprise tool in market. And if they don't just go ahead and outright acquire Anthropic, I'll be surprised. On the infrastructure side, the other data that I have is that infrastructure builds are really slow, right? So they take forever. There's half of the time in infrastructure builds are the permitting process, and about 12 to 30% of the cost is just in permitting. And so we're just reaching the phase where a lot of those permitted projects are going through, they're breaking ground. And one of the big shifts in the industry is that these companies are shifting from 3 bids and a buy style purchase agreements to long-term contract purchases. And this is for things like the heavy electrical equipment that goes inside the data center, or UPSs, racks, cabling, all the kind of supplies that you see in the data center space. And so what's happening is that the hyperscalers and sort of the tier 2 hyperscalers are locking up all those contracts. And so that's going to butt up against the new entrants in the market that think that they're going to come in and build GPU clouds or special purpose clouds that are going to compete against Amazon or Microsoft, et cetera. So I think there's a real supply constraint there that is now going to become very obvious by the end of the year. The growth of those upstarts is going to be strangled, and so anyone who's looking for real capacity is again going to turn to the hyperscalers. So again, I think they've successfully blocked the threat to their incumbency by the upstarts, and they're just going to let the economics play out now. So I'm very bullish on in the cloud space and for Amazon, and for to a lesser degree Microsoft, and to an even lesser degree Google. So I think that Amazon's going to win it, is my position right now, and that's going to play out over the next year. So coming up this week, things I'm looking at are in detail things like Netflix, Tesla, not because of vehicles, but because of their machinations around AI and robotics. I think there's about to be an announcement in the next couple of weeks about huge data center investments that Tesla's making. And I think that's going to lead maybe to some potentially speculative purchasing of Tesla stock. On a model basis, like I already think Tesla is above its target price right now. but with all the rest of the noise in the market and Elon moving all of his companies to Texas and probably the capacity announcements they're going to make in the next few weeks. I don't know if it's going to come next week or the week after that. I don't know exactly the timing, but I know in the next little while, like in the next, like this quarter, basically into this quarter, we'll probably hear something about it. Other things like Netflix. Netflix is one of those where I see a potential bear case. I don't know. Is Netflix in your coverage, Wahdy?
Mm-hmm.
You track it? Yeah. Okay. So I'm sure you're aware of all this, but the co-CEO thing to me is always like a huge bear flag. Like I think the co-CEO thing, I don't know why companies think this is a good idea, but it creates, in my experience, widespread dysfunction inside the company. So anytime I see someone announce co-CEOs, I'm like, short, just two things, right? If you're building a new headquarters or you have co-CEOs, it's like almost a default short. That being said, earnings and revenue and subscriber growth in Netflix has been really strong, but we're entering into the period where they have seasonal weakness. People go outside and do other things in the summer besides sit inside and watch Netflix. As you know, they had slashed their content production last year. They're ramping it back up this year, I think, to 17 billion. But a lot of that content hasn't materialized, and a lot of people aren't happy with the content that they have. The other thing is that they've been ratcheting down on sharing of passwords and other things, and I think the pressure. The intent obviously was to convert people to subscriptions, and so my bear case is that instead of converting people to subscriptions, people are just like, well, there's nothing to watch on Netflix anyway, right? So I think that there's actually a risk to their top line subscriber counts going in, for this quarter due to both seasonal weakness and general dysfunction, and the fact that they have a new leader of advertising who came on board late last year, the co-CEO thing. Like there's just kind of a stack of things though. So I intend to position for a bit of a so one thing to note is that realized versus implied volatility in these earnings things in Netflix. Netflix for the last 3 years has almost uniformly mispriced earnings events. So I think just trading straddles into Netflix earnings has been profitable, like going back over a year. So I intend to position kind of accordingly, provided that vol stays where it is, or is less than it is. Like I think again, vols could get cranked here if the market continues to sell off. We'll see vols really pick up in the single names, and of course it's earnings, right? But on a straight vol model, my trade is going to be long vol into Netflix with a negative delta bias, and that's kind of like my work for the day. I think that's kind of what I got. My two trades of the day are those.
Got it. It's interesting that you bring up Netflix in that bear thesis. I'm actually on the bullish side. I think that Netflix is probably better positioned to perform this quarter, and the reason boils down to a couple of things. So, let's talk about like the password, and account sharing, strategy that they've ran. That's honestly has been quite successful for Netflix. The big thing about that whole program is they found out that running like a cheaper ad, like freemium tier, actually juiced up their ARPUs. So I think that that's something that is like a structural tailwind that I think is pretty positive for Netflix. The other thing that I like about Netflix's posture, in the industry is that last year you had a big, you could say that budgets for all the streamers and content, like all the studios were cut. Netflix continued to invest last year. They're the only major streamer that continued to purchase and acquire content last year. And so I think that actually puts them in a better setup this year and into next year from like a content, standpoint. I think the last year, what happened was, you had a dynamic where, you had the strike in Hollywood, right? The Writers Guild strike. And so all of those dynamics resulted in just like a decrease in the amount of content generally. So I think that that's more of like an industry-wide dynamic that was taking place. But now we're going to start to see all the additional bits of content that Netflix was able to develop when everyone else was cutting back. So that's why I think that they're like in a better posture than the other companies. The third tailwind is, you mentioned that they brought in the advertising executive. I think that's a really positive dynamic. So, well, one of the things that Netflix did when they announced advertisements is that they did this partnership with Microsoft, and I think everyone in the ad tech community was kind of taken aback by that because Microsoft doesn't really have a really strong, ad tech, program. So people thought that what will eventually happen is that Netflix will move away from Microsoft and just end up using like a major DSP or something like the Trade Desk or a name like that. And so I think that, we're still working towards that. But the huge reality is that, everything is an ad network, right? And that's like probably one of the best ways for Netflix to enhance its monetization. So it still has like a lot of levers to pull from that standpoint. So this tells me is that like we're not at peak earnings yet. And because of that, the company has a lot of levers that they can pull on to continue to grow to grow the company beyond what is already kind of known about what is already known about them. So that's the kind of dynamic that I think is like set up in the like behind the scenes. I do think though that streamers and content platforms, we're at a period where like like last year, like 2 years ago, everyone was launching a new streaming company, right? And so I think what we're seeing is, we're entering into a period, right? We all saw the Paramount, deal, but like we're entering into a period of consolidation. And I think, what's going to happen with that is, you'll end up seeing that the couple of companies that end up coming through this will probably soak up a lot of share. So I'm not sure if this means that Netflix will make some acquisition, but I think what it does mean is that there should be some benefit there as as their competitors try to work through those issues. So, what tends to happen is when you have, firms kind of consolidating, you're going to see some like, sweetheart deals that are put out. That's going to impact those companies' ARPUs. But the thing is that because each of these streaming platforms has their own like IP, if you're not doing that, then your ARPUs won't decline. So I don't know. I think that it's a very positive backdrop for Netflix. I think that if you look at estimates, and revisions for this quarter and then for the next 12 months, the different scenarios that are really baked into the stock are, I feel like on the bearish side, a lot of people point to maybe like a slowdown in consumer. And how, if consumers start to cut back on spending, then Netflix will be one of those discretionary purchases that goes. I think that the thing is that that's true. It's definitely in the bucket of things that would be cut, but at the same time, an important thing to note is, within if people most people aren't just subscribing to Netflix, right? They're like I got like a HBO Max, I got Netflix, I got Hulu, Apple TV, and I'm gonna look across my platforms to then determine what I'm gonna cut. And Netflix is probably like, given its product market fit and its positioning, and I think the new content that'll be coming out, I think it'll be one of the last companies to be cut. And so that means that I'm a little bit more optimistic also on subscriber growth through the next 12 months versus the stream. So that's kind of like the way that I'm saying this. Like I understand the bearish consideration, and also the stock did rally quite a bit. So there is a bit of that. The market seems to be like positioning back to the concept of like it's swinging back to the scenario that like, okay, maybe everything is like good for Netflix. So now maybe the risk reward doesn't look that great, but we'll see. I'm still positioned for it, so we'll see how it goes.
Yeah, and I was, I think I agree with like 100% of that actually. And I was like last quarter, I was also positioned bull into Netflix and got, of course, my face blown off by it. And I kind of see it like a similar scenario where the stock had a big run up into earnings and then, sold off quite drastically on the print. This time around, there's some like structural advantage too. Like you can kind of buy the you can buy the 20 delta puts and sell the 5 delta puts and kind of create a 4 or 5 to 1 risk reward kind of trade. I hear someone on the call that's starting at the same time as me. Is the video playing? Front of the call.
I think it's coming from
no,
you.
is there someone?
Yeah. Sorry, guys.
Sorry.
Yeah. So you kind of structure a 4-to-1 or on the short side of this, and if it prints up, you lose one, but you win the rest of the time on the downside. So that's kind of my positioning in this, is to based on prior experience, and also just looking at this, like, kind of the stats on how the thing trades on earnings, right? Like, just looking at like my vol model stuff going back forever. So in the last like forever, basically, the straddle P&L, like if you've just been invested in straight straddles, 10-day straddles, like in Netflix, prior to earnings, you'd have made 401% on that. So the average move tends to be 11%. The implied move is currently 8%. And so, when you look at the, I have a risk premium model I look at too. And so there's a negative risk premium. I think Netflix vols are underpriced. Now, when they move, if you look at the call versus put P&L on those straddle positions, the puts are up 759%, the calls are down 36%. So, when you get these big kind of parabolic moves in Netflix, it tends to be to the downside, is what it tells me, just on the straight distribution. And given that the stock is traded up, that's part of why I'm positioning this way, right? And with the fresh experience of last quarter, like I don't think I want to be very long in Netflix this quarter, even though I actually agree with, like, I think 90% of everything you just said on the bull case. It just seems like it's like all that's priced in to me, I think, right? So this is a bit of contrarian trade, and not for the faint of heart, but also not like a huge position for me. So this is like I might take a 1%, like 100 bip ding if I'm wrong. I can't hear you anymore, Wahdy. You guys hear him?
Can you guys hear
I
me now?
think, yes.
There we go. Yeah.
Okay, there we go. So many different microphones going on here.
Yeah.
Okay, so I think that no, I hear you, and I think that what drives volatility in the stock is really the surprise, right? So if investors are positioned for something, right? So last quarter, what happened with Netflix is, what's the story been this year? They stopped reporting the number of subscribers, right? They stopped reporting a bunch of details. So there was definitely that, like, negative like headwind, but like that I think that was like a good dip to buy, and that's actually when we when we kind of got back into the stock. But I think that kind of moving into earnings, definitely there's been, multiples have expanded through the time, but they've kind of come back a little, over the past, say, 10 days, 10, 15 days or so. So we're not positioned at like peak multiple, into earnings. And I think that's say a positive dynamic. That tells you that market is not overextended, on this. When I look at like OPX, and so this is kind of like, and this is not what I'm gonna base any trading decision on, but this is just some good context. So over here, for example, I've got this is this is Netflix trading on next year's estimate data. So, when I typically look at the stock, I'm gonna look at like their EV to EBITDA, maybe their EV to sales. And then this is their actual next year EBITDA estimate. So next year's, estimate is at 12.5 billion. Stock is trading at 22.8 times. So you can see that, more recently it's just kind of, come down a little. It's not a massive shift, but definitely it's not trading at the peak. And so, I think that's a slightly better setup. It means that people are kind of positioning out of the name. And then if I take a look at this is like the traded, this is like the traded contract, right? The July expiry, or the ones that expire this Friday. And it's primarily put side, right? So that tells me that there's a lot of like bearish positioning in the stock already. And when I look at, okay, well, my tea leaves, what I think is happening to estimate revisions, what do I think are like the positive dynamics? Yeah, this is the risk that I'm willing to take. All those put buyers, that's going to be subsequent demand. So on a stock, right? So, I think that in that dynamic, you can get a positive, you know, positive digestion period. But, and we'll see how the stock trades tomorrow, because if there's like a big surge in call buying, if the stock is like up dramatically or like up versus say the S&P or Nasdaq, then we'll know if like people are like really like betting on a big surprise. If the metric misses and people are positioned for a positive surprise, then you get that big reaction, right? And that tends to happen with all these meme stocks. But I think that we're actually now in a situation where I like the risk reward. I think that the bull thesis has legs, and I think that there's definitely upside for next year's estimates. So that's kind of the way that I'm looking at it.
I'm just going back and look at the prior cycles, ratchet and trade through.
You said you have the logo?
And yeah, I guess we shed 7% in a pretty short period of time. So that is a little bullish, into the print. But I think a lot of that is beta, although it outperformed today, right? And previously. It was only down 1% today into that huge tech sell-off. So I think tech overall, when I looked on my other screen, but the aggregation, like my own index of tech was down like 4% today. It's a huge, huge print. It hasn't done that in years.
Yeah, I mean, I think that I think though that like, and I heard that, and it's funny because like my business partner was also like this morning messaging me saying like, this is a factor rotation, and it was giving him premonitions of 2009. And like he was a PM through that period, so I think you were running a fund at that time too, and so I think that's definitely important. I think a distinction or a difference I would point to is there. So right now, if you think about like the tech trade or like tech AI, right? There are a couple of like tailwinds behind it. One is this is actually the one area that's seeing like positive growth, from a spending standpoint. At the same time, it's also, been in a situation where definitely a lot of the companies, in the sector have been super correlated with like a high beta, high momentum sort of a factor risk. And so what I think is happening is that high beta, high momentum factor risk, yeah, that is definitely for sure turning. That's going to be a factor rotation. But the underlying trend is like the estimate revisions. I think that's still positive. Like the story hasn't fundamentally changed there. I mean, sure. I mean, is there a risk of, China invading, Taiwan? That's always a risk. And sure, of course, it's going to impact things, down the whole, AI and semiconductor value chain. But at the same time, I'm not sure if that's something that like, would be priced that in right now. No, like that would, okay, you could trade that, in January, 20th, or you could trade it, if China actually makes a move. But right now it's like pure reaction. So I think what's driving the big move is really just that we're like in an air pocket from like a seasonal demand structure. So that's the kind of setup that I think that even a small little thing creates a huge kind of sell off. And I think we're gonna see like these rolling sell offs through the next 4 to 6 weeks. But I think it's gonna be like different things. Will the high beta, high momentum factor create a further sell-off in semis and in these stocks? Oh yeah, because they're still super correlated to it. It won't that trade won't be done until that's over. And the factor rotation can take, some time. I think that the flip to the factor rotation is that IWM is becoming that high beta, high momentum trade. So like that's the flip side of that. And so when does that get a surprise? I think that gets a surprise through earnings and also after the FOMC. And so I think that we'll probably see that kind of a flip back almost by the end of the month. So yeah, I'm kind of like postured in a way where I've reduced my exposures to, across the scene. But I think that the underlying dynamic is still strong. And so the markets tend to like overly extrapolate. If the market overly punishes that sector, it's definitely going to be a good, a good reason to kind of like add to the stock.
Yeah, I'm just looking here at the chains, and we'll see what it does tomorrow. I'm still inclined to take a small position in it. I don't have anything in it right now. I may flatten out the delta curve a little bit because I think to me, like, to be long, the time to buy this thing was when you did, back in May, on that last print. That was pretty juicy, and I caught that between May and June a bit, but I sold it back in early June. So that last little bit of the move I didn't catch at all. But yeah, I think to me this is for the week is going to be just a pure kind of realized volatility trade. And you're putting me on the fence about my delta bias a little bit. But I might trim it when I put it on tomorrow. But we'll see where we get tomorrow. I'm going to put it on tomorrow, obviously.
Yeah, I think that's the right way to do it. I definitely have a position now, but it's not like it's not a super big position. I do think though that there's a good like expectations gap, and I think that that's going to get filled. But the question that I've got is like whether it's going to be a this quarter story or a next quarter story, and I think that what's more likely is it's going to be like next quarter. So I think this quarter is going to be like a slightly better, inline print. Nothing too major on the, no like really big like step up in guidance. And no big like serious catalyst for this quarter, but I think that ad story is going to get more and more important through, the rest of the year. And so I think that that's going to become a bigger, like next quarter or maybe even, calendar quarter one, next year.
I said too much. Someone else say something.
Let's go ahead and switch over to coverage then. Andy, you want to give us any updates on EVs?
Yeah, sure. So I quite like James, we just talked about the Tesla data center. Obviously, I've been focusing more on the auto side of the business, so it'll be interesting to see it play out. Is it related to the Dojo AI that you're looking at, or is it like more like autonomous driving?
So I got the truth is I don't know like what the use is, other than I assume just racks and racks of GPU. But I just know they built it in an awful hurry.
Right.
Like under a lot of pressure, and they were doing stuff like last year trying to connect it, via microwave and stuff because they couldn't get the fiber trenched. They were doing all kinds of stuff in this project to try to get it live.
Mm-hmm.
And they did break ground on it. So I think it's coming, and it's going to be like it's going to signal that Tesla is playing in AI in a more serious way. Because I think like when Elon's compensation was at risk, obviously everyone got kind of positioned short into that until that risk passed, and now now everyone's got back in their bull cases. But he's made a lot of noise, right, about XAI, and I think he was teasing at the time like, well, if you guys don't want to pay me my compensation, maybe I'll just go start XAI and just do that. And you guys can run Tesla by yourselves. I don't think he was bluffing about that either. I think that was a real risk.
Okay.
So I think now that he has secured his future, that he's going to continue to pivot Tesla into AI. Yeah. And I don't even think that that's necessarily, I mean, there's nothing surprising. I mean, he's been signaling for a long time that he wants to do a licensing deal for Tesla software and the platform. And I kind of already expected that he would, once China cut him off in the low end market, that he would sort of pivot and it's like maybe spin out an OEM or something and just license the manufacturing capacity to other automakers and just have like a residual revenue model on the software. And I assume he's still going to do that. The question is, if he does that, then what is the impact to Tesla guidance? And so he won't do it, I don't think, until he has a narrative in place for like the new thing, the new master plan, right? And so the new master plan is going to be, we're gonna retool Tesla's manufacturing capacity to make 3 robots for every human being on Earth, and they're going to be fully autonomous, blah 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 blah. And the signals to that supporting that narrative are like, we sunk X billion dollars into building this gigantic research facility, this gigantic data center for all of our machine learning effort, dot dot dot. So there'll be kind of like a rolling thunder of these things as he pivots the narrative away from vehicles and chargers and more towards like more like a SaaS company almost, where he's licensing this stuff. And so I think that's a start. I think that's in play now. I think he's going to, I think everything that he does now is going to align to the narrative of Tesla's future, as in like, we're going to build robots and then fly them to Mars and then set up a colony and we're all going to go,
All right. Okay. So from my kind of perspective on the auto business side, obviously we've kind of hit like a bump in the road. For the auto business, we've seen a slowdown in sales in Q1. China, US, I think major markets are slowing down with the EV adoption. That was a trend happening in Q1. And now, like in Q2, we're slowly coming out of that in the auto business. I guess like that's what's kicked off this rally. Since since the delivery number release in the beginning of July. So over the last 3 weeks, basically. And on the computing side, what's interesting is like, because the auto business is kind of limited, he wants to find another stream of revenue, which he said is going to be the robo-taxi. And in order for you to have a full self-driving, and then in order for you to have that, computing power, then you have to have this, massive stack of GPUs to calculate these end-to-end neural net, FSD software. And he said actually on the earnings call, he's going to order 85,000 H100 chips from NVIDIA this year. I think that's his plan. And it's kind of like, I kind of agree with what he's doing, because now he's shifting into a vision only method, which requires a brute force, kind of approach to the issue. Waymo's doing its own clever thing with LiDAR. China's doing this human assisted, model. So Tesla is doing this vision only that needs tons of computing power. And I think 90% of their computing power is going to come from NVIDIA. 10% is in-house Dojo AI. So this is like what's the setup, because if you don't have like level 4 self-driving, you don't have robotaxi. So that's what everyone was betting on the August 8th robotaxi event. But now he kind of postponed it to October. So now we have that catalyst out of the way. It's only the earnings that's left. I think, next week or like the week after. July 23rd, I think. Yeah, July 23rd. So that's the setup here. So I was like, I think maybe he'll tell us more about the progress of the computing power he had in the next couple of weeks. But I think the big event everyone's trying to bet on is, can you solve level 4 autonomous driving by the October event? If you can, then you can release something, put it into production, and then, everyone's going to ride around in robo taxis. If you cannot, then that revenue stream is not going to happen in the next 12 months. It's going to be pushed back to 2026, 2027. And I guess I guess that's really what's at stake for Tesla. You saw that big sell-off last week. It's because he decided, Bloomberg said he's going to postpone the event. So everyone who's trying to position for the August 8th has to push, their bet back. And so yeah, for me, two critical factors. One, can they get the auto business back on track? To recover from that trough in Q1. Second, can they pull the robotaxi off? Because if you have the robotaxi, then the same technology can be applicable to the Optimus humanoid robot. It's like you can migrate that technology over. But first of all, they gotta crack the robotaxi, and that's just my take on Tesla.
Andy, were you able to like figure out what the bump to estimates are with Robotaxi and say Optimus?
So I haven't got to that yet. I'm still building on my cost build for a Tesla model for the last. I was doing the revenue, and today finished the revenue and cost build. I'm just cleaning up my model. But once I've done that, I will add in the future revenue stream. So it on the total addressable market, it's pretty funny because I think Mizuho gave us like 40 billion. Kathy Wood come out with 8 trillion to 10 trillion global revenue per year. And I actually included in my note today, just as a reference, US GDP is 28 trillion. Global GDP is 100 trillion. So he's saying like it's going to be 10%. Robotaxi ecosystem is worth 10% of global GDP. That's pretty funny. And adding on to that, she said Optimus is going to be 24 trillion. So together, Tesla is like 1/3 of the global GDP. I just think that's just crazy. I'm not saying I don't think that's true. It's just she's trying to pump up the stock. But more and more sell side are coming up with models to predict the robo-taxi business, how profitable it's going to be. And I'm trying to figure out which one kind of makes most sense, and also for the Optimus. So that's a work in progress. So I'll keep you posted on that.
Cool. I think one of the things that you could do is because these are not going to really be material to Tesla revenues this year, and they're not going to really be material to revenue next year, because say if they launch something, it's going to be sometime next year.
Yeah.
Then we'll start to see something the year after. So fiscal year 26, 27. And so what I would do, and so this is where it's like, when you're building a model, it's kind of tough, right? Because it's like when you ramp, like ideally you just like you pause everything and then you build your model, and you make sure that it's perfect, and then you go from there.
Yeah.
But in the the way that, like, if you're we're I don't want to say that it's live, but it's like we want to know what's happening with the stock. So what I would do is I would probably I would try to do this, like, this is like on a prioritization level. I would say like the revenue build is definitely more important than the cost build. Although it depends on what the critical factor is, right? In this case, like the critical factor is a new potential TAM. But I think, like, so what I would do, and what I would do in your model is I would look at 2027 numbers, right?
Yeah.
2026 and 2027, or 2025, 26, 27, right? And I would take a look at what is my revenue implied by, like, the current trajectory in solar, the current trajectory in energy, and the production guidance for for the vehicles, right? Based upon my ASP. So what is the actual revenue contribution from the current business lines that Tesla has? And then where are estimates? And I would look for the gap, and that gap would reflect the sell side estimate, component from, or contribution from the robotaxi, or say robotic side, right? And I would see, like, okay, that's 2025, and it's probably a small impact. And then 2026 would probably be a larger impact, and 2027 would be an even larger one. So I would lay those out, and then below that I would say, okay, well, what is, like, say a reasonable TAM, for these things. I think for an Optimus model, like the thing with the thing with Elon and Tesla is that stock probably should trade at a lower multiple, but it doesn't. So the market gives him a premium because Tesla is a meme stock, right? And so it's the multiple is not it. You almost have to like 2x the number to some degree. I would say look at the historical spread of like Tesla versus its traditional OEM, peers. And that
Oh yeah.
that spread, like whether the spread is higher or lower should tell you like the memeness of the stock. And then you have to just adjust the, your implied metric by that. But okay, so that's what I would do. And then to actually get down to what the TAMs are for these, take a look at like Uber and Lyft, their business, right? Like what is the revenue that they're actually able to generate, this year? What are the TAM figures that they're providing on the mobility front? Because, it's not so likely that that like you could say that I don't want to say that Uber and Lyft have saturated the like alternative taxi business, but to some degree like they've become ubiquitous, right? And so you would expect that in areas where you have a lot of Ubers and Lyfts, you would potentially also see an increase in adoption of, say, a robotaxi business. And so those markets would be a good proxy for like what the size of this business could actually look like, right? So if Uber's only doing, say, 10 billion in sales, then that tells you what if Uber and Lyft combined are doing 20 billion in sales, then that tells you what the actual TAM is, right? And then
Right.
so that would be on the robotaxi front. I think on the robotics front, this is going to be a multi-year period. But I know that he's already demoing some stuff with the Gigafactory already. And so what you would see is, I think the right way to do it is to take a look at other like industrial robotics companies.
Like Boston
They're
Dynamics.
yeah, but the problem with Boston Dynamics is that they don't really have like a public, position.
Okay.
I mean that they've
Maybe I'll
got that
try.
product
Yeah,
well,
I'll find a
yeah, they
deck.
have like a really advanced technology, right?
Uh-huh.
But it's I think they've got like the software side, right?
Mm-hmm.
But there are a bunch of companies that already are industrial producers of robotics for major manufacturers. So think of like a company that supplies Toyota with, robots.
Okay, okay. Like the manufacturing side, right?
Yeah, exactly. Like who actually builds those robots and
Okay.
what's the revenue that those guys make? Because that's
Yeah.
the market that Tesla would win in, right? Like, you're not
Mm-hmm.
just gonna like no one's just gonna go out and buy a robot. Like
Yeah.
the people who are gonna buy robots are the people that already buy robots, and this is a better robot, so you should buy this one, right?
Yeah.
It's not like a new, I wouldn't say that it's a new product category yet. Like maybe, in
Mm-hmm.
10 years, or depending on how good the product is, could be even
Right.
sooner. I'm not saying no, but I'm just saying like if I were to estimate it, I would look at what is the existing market for like robotics and then
Mm-hmm.
use that as like the TAM that Tesla could build into. So if say there's like you find out like the actual TAM that you've estimated is say altogether like maybe 80 billion, okay, by 2027,
Yeah. Mm-hmm. Okay.
then you can say, well, how much is the market pricing in that amount? And do you think that that's reasonable? Like, is it okay? That would be like your base case, but then what is your view,
Mm-hmm.
right? You might say, well, I think that's Tesla's probably gonna like maybe they're gonna do like quite a bit less. They might get to like a 20% penetration, by 2027. So in that situation, it's like okay, then they should only be getting 10% or like a $10 billion increase to revenue estimates, and sell side or like the market implied is like 50 billion. So
Mm-hmm.
that tells you that there's like a really big expectations gap. And then again, because there's a memeness to the stock though, this is where you've got to use the discount or premium to comps to tell
Yeah.
you that like
Mm-hmm.
that's your scalar, right?
Mm-hmm.
But then you can do the adjustment. You can say, okay, well, what is this then on an adjusted basis? And maybe like the memeness has made the multiple look like it's 100 billion in revenues, but when you adjust it, it's probably like 20 billion in revenues. And now you're
Mm-hmm.
like, okay, well, 20 billion by 2027, yeah, that's kind of reasonable because I think that the TAM is 80 billion by that time period. So yeah, okay, this fits. I could see this. And then
Mm-hmm.
you lay out like, okay, one is like the path of like information. So okay, we got like an event here, right? Quarterly event, robotaxi event, blah blah blah, right? So you lay out like when are
Mm-hmm.
you going to get the incremental information? When are you going to like when are the flops, right?
Right.
And if you can kind of tee those up, then you know, like, okay, well, what's positioning into that flop, right? And are people going to get surprised to the upside or downside? But I will say, so early, like we're so early, or like there's no revenue yet. And so the problem with these names, okay, with these like, this is not a meme stock issue. This is like a startup issue. Is that, you know, there's this like a really weird logic in Silicon Valley, James can probably speak to it, which is that it's like, it's better for your company to be like pre-revenue, right? Like before you actually have any revenues or profits, like just talk big about the TAM, right? Because that's what gets people excited. And that's really that's really true. So I think that like you know, it's gonna like the premium, right, will decay, but the question is like how quickly will it decay relative to the realization of that future cash stream. I think that you know, you're gonna have to estimate that. But that's how I would actually approach it on your model.
And what's interesting is this is a dynamic between your first revenue stream and second revenue stream. The reason is the more robotaxi there is outside, there's going to be less demand for the private passenger car. So it's going to kill off your, you know, auto business slowly. And I think that's why like looking at the Uber and Lyft TAM will be more realistic. Because I think what Kathy was trying to do is you say, oh, you buy a car, use it for like 2 hours every day. But then what if it can run 24 hours? You time that by 12, boom, you got a huge number, right? But that's just not realistic because she's doing it assuming that everyone's still gonna have a private car. But if you cut that down,
Didn't she also say that we were gonna have 40% GDP growth?
Yeah.
Oh, did she? Well, I mean, it's
so
good
if we
to
have 40%
understand-
GDP growth, then Tesla can be worth $30 billion or 30
Yeah.
trillion, sorry.
Right. Yeah. I mean, we you know we've got to understand the ultra bull case here, right? From these crazy guys, but we you know understand how they're calculating it. But you know, from Uber and Lyft time, it's much more realistic. And not gonna lie, in the auto business, I think the product cycle is much longer than like cell phones or other like you know electronics. So it might take a much slower adoption, you know, than you know the rate we saw in like electronics or like you know cybersecurity, right? It's going to be a lot slower. So yeah, I mean that's my update on the EV coverage side. Some read-throughs. What's interesting is from the on the German side, BMW, Porsche. You know they're you know, on the sales side, people think their guidance quite ambitious, and you know, the long-only guys are looking at their margins given their deliveries already down. You know, Porsche down 10% year over year due to softness in China, and you know that's something interesting to look at on the German side because you know how much of effect does Chinese cheap EV have on European soil? Like that's something I want to keep an eye on because you know, in the Chinese makers having like Great Wall Motors and you know BYD, they're having like a really great year, not only domestically and in the export market. And there's another thing that's hanging, maybe you know, going back to Yefeng's point about you know paying attention to China plenum overnight, which is you know you have this EV you know tariff raised in EU and US, and China has been saying they you know probably going to retaliate on these you know the ICE vehicles with large capacities in the engines. So that will hurt BMW, Mercedes, Volkswagen, Porsche, and you know, and that's probably the reason why you know the long onlys are paying attention to the margin side rather than you know the headline delivery expansion. Um, so yeah, that's something to pay attention to and use as read-throughs on my EV coverage.
Nice. That's a great update. Thank you for that, Andy.
Cool. I'll pass that off to Barnaby.
Hey guys, yeah. Today I've been building the DCF for Dynatrace, so pretty much filling out the cash flow statement, and I think I've figured out the whack, so I'm close to being done. I think I'll easily be done by tomorrow. I plan to just finish this piece of schoolwork while it's all in my head. So I don't know how long that will take, but this is probably going to be my update for the next few days.
Nice.
Yeah, I noticed
Did you guys have
Datadog
did you guys have a conversation about observability yet?
Oh no, I don't think so. Yeah, James, I want to get your take on Dynatrace versus Datadog.
What do you want to know? I know a lot about Datadog. I don't know very much about Dynatrace.
Okay, fine, because yeah, we're really looking at pairs trading them. So I'm really interested in the kind of competitive position between them. Why you might choose one over the other.
I mean, I've used Datadog quite a bit in production, and I mean, my view on it is that it is still the premier tool in the space, and a lot of that has to do with its flexibility. You can kind of take any kind of adapter or API, anything that's outputting metrics, and one way or another, you can cram it into Datadog, whether you're using agent-based collectors or just the remote API calls and stuff. So for that reason, it's really popular in companies that have a lot of kind of scale out infrastructure. And what I like about it is you almost can't live without it in that world, because and to give you the background context on it, in the last really 10 to 15 years, there was a big movement in software development to containerize and create discrete microservices, and that created a real mess, because to decompose your monolithic application to microservices makes a lot of sense, because then you can just scale each tier of your application horizontally whenever you need to, and it's all HTTP or web based, right? So you can load balance all of those tiers, and you get a lot of efficiency scaling exactly what needs to scale at a moment of time for basically all these API backends and web apps, etc. Could be anything you're talking about, like a backend of a mobile app, or any kind of e-commerce site. I mean, anything like that basically is going to use that style of architecture these days. The problem is that when you do that, there are all kinds of infrastructure related problems that can arise. Individual hosts or individual VMs can run out of resources, CPU, memory disk. You can have network latency or congestion between microservices that are talking to each other on different nodes, et cetera, et cetera. And so for that reason, because it is all complicated and distributed, you need to get observability down into the physical infrastructure as well as the virtual infrastructure. And what Datadog does is it makes a really good unified view of all that. And so it's kind of just like at this point, it's kind of just like a default choice for, like, if you're in the business and you've been in the business and you're doing something new or you're scaling something that exists, you're probably just going to kind of use it by default because it's cheap enough, and you already know how to wrangle with it. AI is introducing some different observability problems, and so the background on that is that the way these models are trained is primarily on the training side, not the inference side. When you're training, the data set is split up and then sprayed across a bunch of nodes, and then there's a lot of communication between those nodes that tends to saturate the network, and this is why we have the fastest uptake in an Ethernet technology via 800 gigabit Ethernet that we've ever seen. So we're kind of going like 0 to 100% market adoption in 6 months or something. Like, it's kind of crazy, and that's why companies like Arista are doing really well, and why NVIDIA bought Mellanox and so on and so forth. Okay, so there's a lot more sensitivity to what's happening in the network layer than there has been in some time. Like, if you had, like network latency that was congested, or like, it increased the latency of some database query, or, some service to service API call or something, like, you didn't really care that much unless it became an exponential problem. But in these, like, if you're working with AI and that kind of infrastructure, you really care about things like jitter and stuff in the network that because it slows down the entire training process. Like these nodes have to move in synchrony. Okay, that's really different than the request response world that we've been living in for the past 10 to 15 years. Okay, so there's some new observability stuff, that's happening, and even some like predictive analytics stuff that's happening. And it's something I'm actually trying to get a beat on right now by, through primary research and talking to practitioners and like what they're doing about it. And so I don't yet have great practitioner insight into how they're solving the problem, but it's also something I think Datadog is making machinations around too. So I don't know if that helps on context and background, but that's what I know about Datadog.
Interesting. Yeah, Datadog recently announced something called LLM for observability, and they did a convention thing on it. Are you familiar with that?
I'm not, but that sounds like the droids we were looking for.
Right. Yeah. So there's a bunch of research of people who went to that convention. I think it lasted for 3 days. They actually released loads of products, but that was one of the big ones. So
I'll look into that because I haven't caught up on them, strictly because I think momentum died off on the stock, a couple quarters ago, and so it hasn't been on my radar. But I'll go take a look. And one of the things I'm going to be doing different this quarter is organizing these primary research calls where I get like 2, 3, 4 people from the biz together on like a conference call, and we just kind of talk about what they're doing, the challenges they're facing, et cetera. So I'm going to be publishing some research notes out of that. And so I'll make, this was on my list anyway, so I'll make it a priority to try to get some insight into.
nice, great, thanks. Yeah, please definitely send that my way.
So I do have a question, and that is, what have you heard about pricing? Because every expert call that I've had, every transcript that I've read, everyone keeps talking about pricing as a bottleneck for growth for Datadog. Like, it's not so much that they don't have a great product, but it's that their pricing makes them vulnerable to competition where there's like a comparable product.
Yeah, well, okay, we always see this in the technology evolution, right? So once someone gets in the market and establishes themselves as a player, someone else comes along and introduces a substitute that has either like some pricing advantage or some better, faster, cheaper story. Okay. And what ends up happening almost every time is that 2 things happen in order. The first thing is that the incumbent responds to the price disruption by repricing themselves or rebundling themselves. So particularly if they have a portfolio like Datadog does, they'll just shift their pricing model where whatever axis the competitor is trying to disrupt them on, well, now they're providing more value at the same price. And the substitution can't compete with better, faster, cheaper because they're not better than the entire bundle of the services. So I don't know that they've done that. Again, this is just the playbook. I don't know that they've done that or are doing that yet. I'll go research it. Okay, so the second thing that happens after that is that the company that was trying to disrupt better, faster, cheaper pivots into being about a niche, right? So these guys are like, they're chasing the dragon, and then they get market traction. The competitor takes notice, they adjust their pricing strategy, and then the little guys swing into competing viciously for a niche. Probably, I'd have to guess, probably around AI. And so that's what I would expect without knowing anything else, in the current dynamic. I just expect that to happen because that's what always happens almost invariably. So there is a trend, there is a pushback in IT against SaaS anything, and against IaaS as well. The complexity of pricing is leading to variance in the IT budget, and that is something that gets the leaders' hands slapped, in an embarrassing way, at the executive level. So, you have a budget and everything's going well and all your lines are tracking, and then something changes in the use case and it drives up utilization of some piece of shit cloud service that you're using and you didn't budget for it. So now you have to go back to the CFO and say, well, our cost of this service was 10 times what I predicted and it's going to stay that way. Sorry, right? So, and that's been happening now for a few years. It happened a lot with Amazon before they before the reserved instance pricing thing really took hold and companies started to make longer term commitments, back in the on-demand usage days, like it was a real nasty problem. And also Amazon's billing is incredibly complicated. So complicated that like 20 startup companies emerged to try to just solve Amazon's billing for them. Okay. So the rest of the SaaS companies are the same. Like there's complexity in how they're charging, and it's difficult for the buyer to predict, what the cost is going to be. And so there's a push now, a trend that I even wrote about in a venture beat, about kind of going back to old school software, because the buyer is just like, can I just buy this for a year for a fixed cost, all I can eat with updates, and guess what? I'll pay you again next year, but I just don't want this variance in my life. I just cannot deal with this. So I think everything you've heard is correct. It is a barrier to growth, and the entire industry, not just Datadog, I think, is going to shift back more towards like they may not be you own it, style software models, but it's probably going to be fixed pricing in chunks, so that everyone has really predictable costs going forward. And that will fit very nicely within the annualized sort of purchase cycle. And typically these agreements have some leeway, like they'll let you use more than you bought for the contract duration, but when it comes up for renewal, they look at your new baseline and say, well, you were 50% over the baseline for like 9 months of the year, so we're going to charge more, going forward, and that'll be the new baseline. So I think that style. I talked to a company, a startup actually, Arky, which is a pretty hot. It's a bunch of guys that left Hugging Face and started their own play, and they're trying to do like model training and orchestration and pre-training, and they have a here nor there, but they have a way of merging models, like taking the best of a 7 billion parameter, another 7 billion, and like merging the model weights into a single 7 billion. Anyway, Arky, check them out, ARCEE. They just got 24 million, I think, on the heels of their 5 million that they just got in January. So again, very hot space. But even they, brand new company, they're not doing SaaS pricing at all. They're doing what I'm saying, like fixed fee for a year, renewable at the end of the year, plus support and maintenance type of billing that looks a lot, it's kind of like we went all the way into SaaS and now we're dialing back to like halfway back to like the way software used to be priced. I think that's happening across the whole industry. And everyone's going to jump on it because it's going to create more earnings predictability for the SaaS companies anyway. And of course, they're getting clown hammered, because when you fire people, you just turn off the SaaS and then your earnings are off. And that's what we've seen across like the SaaS sector, right? So I think by the end of this year, it's going to become the norm that there are these like fixed fee agreements everywhere. That helps.
So what you're saying is a complete mean reversion from like license-based like ELAs to consumption back to ELAs.
Yeah, back to like consumption, like ELA plus, like consumption plus or something. Like it's not just an ELA like all you can eat, and they're fattening everything in the cycle. It's a recurring revenue model, right? So it's still an annual or quarterly spend at a certain commitment, and it is consumption based. But they're going to baseline you. How much do you think you're going to need in a year? Well, I don't know. We'll put the peg there, and here's the charge, and we'll pay that for the next 3 quarters, and we'll just see where we are at the end of the year, right? It's gonna be like that, as opposed to like, oh, you hired 10 people and our revenue is up, and you fired 20 and our revenue is down. That kind of like pure on-demand thing is going away. It'll still be there for like small. So I think what you'll see is like a hollowing out, where like if you have less than, I don't know, 25 employees, you'll just be on an on-demand contract, and they'll charge a vicious premium for it. You'll pay a stupid rate, $30 a month per seat or something. But then when you hit 25, you'll flip into like a mid-tier pricing plan, and above that, an enterprise pricing plan. Like I think that'll happen like uniformly across the entire SaaS market.
Interesting. That actually tracks what I've been hearing too, because I've been I think right now there's a narrative. Well, there has been a narrative through summer that like, from an investment standpoint, you want to go and you want to be long the companies that have this consumption based pricing. And in fact, even when we looked at software, we were looking at, okay, well, we want to make sure that we have them tagged appropriately, like this is a consumption based business or not. But yeah, when I talk to salespeople, they've been telling me that, and this is like across the software ecosystem, more so in say infrastructure software. What they're saying is that the pricing models have become more complex,
Hmm.
and everyone is struggling with like how do we get to the right pricing, and so things went from like more of a license-based process but to then some integration between like a license and consumption angle, but it's not perfect. It's like, it's still a work in progress. And I think that this is actually one of like the headwinds for software too, which is hasn't figured out like how it wants to price things. There are some businesses that are just always going to be like ELA type, or license based or seat based or whatever. And then others will need to be consumption. But I think that on the consumption end, that's just going to be like your hyperscalers, because those are acting as utilities. So at that level, they will do consumption. But I think everyone else, they're going to have to figure out something in between. And until and the time that it takes them to figure that out is, you know, the difference in the multiple really whether they should trade at a discount or premium. So no, it's definitely something that
Yeah, well,
I'm interested in.
there's a lot of nuance in IaaS, infrastructure as a service versus SaaS. And the main difference is that IaaS is taking advantage of platform effects, right? So all they're trying to do is drive monetization of the infrastructure, right? And so they will compete very viciously for what they perceive as a high value customer touch point. Like if you think about the value train, like so if the customer is consuming this thing at the top and there's a bunch of people in there selling it, Amazon will go release that for free, okay? And you'll only pay for your cloud utilization. And to me, that's an impossible competitive dynamic. I mean, this is exactly how they won the great cloud wars, right? Is that there were all these software companies, you know, pricing for specific point solutions in the market as like a big healthy ecosystem. And then Amazon came in and said, well, we'll give you that for free. Just, sign here and pay on consumption. It's just the underlying utilization, right? So they're going to repeat that. They are repeating it with AI. And I think that's in the AI startup market, there's going to be smoking craters everywhere of these companies that just don't they weren't around for this competitive dynamic. They're too young, right? So the founders don't know what's coming, right? But Amazon does know what's coming, right? And so they're going to they're running the exact same playbook that they ran to win the cloud. And in a lot of ways, the last year was all about Microsoft trying to kind of front run Amazon's momentum in AI because people forget Amazon has a very healthy multi-billion-dollar AI business that just happens to be based on quote old AI, support vector machines and inference and like quote boring AI. So the LLM thing was just a flash in the pan moment in time for Microsoft to sort of like siphon off. So I talked to I can't say who it was, but I talked to a Fortune 500 CIO, and this is a couple of months ago, and they
Was this
said, "Well,
at a company that you previously worked at?
no, I didn't work there. This is just a Bay Area Fortune 500 company, and they had a big push, at the board level. We got to do something with AI, generative AI, blah blah blah, right? So they couldn't get the models that they wanted from Amazon. They're 100% Amazon shop, and so they started buying. They set up a purchase agreement and started buying Azure. Okay, but fast forward. And at that time, they were waffling like, well, it looks like we're going to be an Azure customer now because of this. But then um, Amazon started to introduce, these foundational model layers and stuff like as cloud services, and so they're now shutting off Azure. So that's a big dynamic, I think, is that they're not alone, right? A lot of those Fortune 500 got experimentally involved with Azure, and then they realized their entire workforce was trained on Amazon, and it was a huge lift to convert to Azure, and it was worth doing to sort of get AI projects off the ground. But now that they're gaining momentum, they're just going to turn it off and focus on AWS. That's my prediction anyway. And that is from, practitioner insight. So I think, all the startups get shipwrecked in that zone, just exactly the way they did in the cloud. I know because I ran those startups back then when I got shipwrecked into drove the ship into Amazon's gaping maw, the Leviathan. So, okay, so the SaaS companies though are, and I think you guys have probably talked about this already, but they're disrupted by like generative AI itself, right? So there's a bunch of SaaSes out there where you can just now kind of do the same thing with Chat GPT, an interactive chat session, and get all the benefits without any of the, like productized user experience. So the thing to look for now in the SaaS portfolio is the companies that are successfully and rapidly integrating generative AI into that. It's basically like a net additive to their user experience. Because to me, like by this time next year, the foundational models will all flatlined in terms of progress. We're not going to have AGI or the super intelligence or none of that is coming for 25 years. And by this time next year, most of the model performance will have flatlined. And so we'll be living in a world where there's a whole bunch of different, there's 2 or 3 or 4 or 5 foundational models, and then a whole bunch of like thousands or tens of thousands of specialized models under that are used in more or less like a model merge or panel of experts style of architecture. And these SaaS companies that stick around are going to be the ones that figure out how to integrate that into their experience and provide basically another rung in the ladder up the value chain, like AI within this specific problem domain. And that's what I'm looking for. Not, again, I'm looking for the moment when that starts to impact this quarter's earning, which is not here. So I'm just giving you something that's far-fetched into next year. But that's, from a little slightly longer term perspective, that's there's a class of those companies that are doing that effectively, and then there's others who are just completely obviated by AI. So good examples of that would have been like, I guess the best example that would be like, Copilot with GitHub and Microsoft. Like that should be, the HBR textbook case for like, how do you rapid integrated technology and trump everyone? Boom, just get it done. And so I think everyone is still behind Copilot. And that is a huge, you think about 2 million developers or whatever we have now globally, right? Like that's a huge segment that they just, ironclad locked into GitHub and into Microsoft. So that was a brilliant play. Got to hand it to them.
Yeah. I think on AI. So I've got this like like an AI roadmap where, I think that the adoption of AI, so there's a couple things, right? There's like enterprise adoption, and then there's consumer adoption. And so enterprise adoption is happening piecemeal, right? We're hearing like every company is allocating out of their traditional CPU or compute spending into say AI. And so traditional workflows are being hurt because of that, but AI spend is rising. Companies are being able to deploy their own copilots using Microsoft. Microsoft has a Copilot Studio, so companies are already integrating this. IBM actually is turning into its own sort of a like non-Chat GPT Copilot Studio, where they're going to plug and play with a variety of different underlying models. And so I think that use case is happening. I see like cloud companies or cloud first companies will probably run that stack on Azure for now, just because Azure has it. In the conversations that I've had with people in the stack, so from say software developers to to CTO levels, there's been a lot of like new blood into Microsoft, and so there's definitely a mixed picture where how many of these people will actually stay. But I think though that the real thing is that you don't even need new logo growth. You just need expansion of existing customers that have their workflows on Microsoft already. Like for example, I've got a bunch of data on Microsoft, and if I could build a Copilot that could go through all of my notes, all of the research that I've got, all of my PDFs, and if I could just ask it to like quickly summarize all the research I had in that folder for me, oh, that would be incredible. Who's going to be able to deliver that? It's going to be Microsoft, because that's where my data is. So I think that is, still a very compelling use case for Microsoft. my actual thesis for Microsoft is just Copilot adoption in the O65 space. The commercial adoption on a user basis, I think, is much higher than expected, and that's going to provide a material uplift. But I think that part of Azure is the big thing, where we're in an environment right now where traditional compute workflows are being like marginally scaled back. Mainly, okay, budgets are an issue, but also because of this desire to invest in AI. So that what that impacts is that's going to impact like Azure's traditional CPU workflows or AWS's workloads. I think most people, and I've seen surveys that point to between 70 to 80% of say LLM adoption is through ChatGPT and Microsoft. So right now, all of that marginal spending is probably done on Microsoft. And that marginal spending is probably not is like materially enough to like lift Azure by like say 1%. It's not so big, and I don't even think that it's the big increase is going to come from new logos. Again, it's going to come primarily from expansion. But that I think is like the bull case on the Microsoft side. For okay, so that's on the enterprise phase right now, but you're still not going to have mass adoption yet. What is the bottleneck for mass adoption? The developed workflows, that's number one, and that still takes time, And so when are those tools going to come out? We're starting to see, agentic AI tools pop up, right? There's like Sienna, there's Sarah, there's a, open context. There's a bunch of these new startups that are led by actual ex, Salesforce, CEO or ex outreach, founder. So you actually have like a ton of talent and capital that's being invested into these agentic workflows, where they're instead of just building like a co-pilot, that's already done. Like the little chat GPT thing on the side, that was already done November last year, right? Now the next cycle, and if you think about how long did it take for the chat GPT integration into like Microsoft Word, it took a year, right? ChatGPT came out in November, right? And then the following November, you got it in Microsoft. So now we're almost running into a year where we've shifted from just Copilot, just a little chat app that's going to help you like tweak your words, into something that can actually orchestrate tasks, run tasks for you, and do it in a meaningful way. So there's another app called Air AI that'll actually make calls for you and schedule appointments and run demos. Sierra will do the full stack. Like you don't need to use Zendesk. You don't need to hire customer support people. You could just hire this app, and it's like $100 a month. The pricing model that these people are deploying is they're starting off with like this basic like SaaS sort of a model, but it's actually going to switch over into like a task completion model, where if they close deals for you or if they do something, whatever, they'll get a portion of that. So it's going to be super interesting to see this whole ecosystem take off. So this is coming. These apps are already out there. They're well funded. There's been a lot of capital that's been put in them. One is like the timeline, for these, probably around Q1 of next year. And the reason why is because that's when we started to see some of these agentic AI startups in Q1 of this year. So for like, say, to see further adoption, we'll need to see what happens in Q1 of next year. So that's the enterprise side. And I think that is going to spur massive enterprise adoption. However, it's going to have to be done locally. And that's where I think that there's like a bull case for, again, there's another like bull case for Microsoft, because they got the Azure business and Copilot Studio, but also for IBM, because they're providing this like, there's a lot of people that don't have data on the cloud, right? They either have private cloud or multi-cloud or on-prem or so on and so forth, or a mix of things, and they may not want to be stuck into one vendor like Microsoft, and ChatGPT. They may want to mix and match, and that I think is something that IBM is actually positioning itself really well for. And the stock is, has totally been underperforming the market. So, let's just put it this way. I'm the IBM bull in the house. So there's that component that I think is a very positive backdrop. And again, like I said, I'm expecting to see more bigger enterprise adoption Q1 of next year. just because that will happen after we already saw the first like wave of these agentic AIs in the startup space, right? And who is gonna like, how is this gonna play out? Well, so I think we've been talking about like Salesforce and like the dynamic that Salesforce has, right? So if you look at these companies, and actually, like I think a month or two ago, I had Barnaby and Gene and a couple of others work with me to go like categorize software companies to see if they were developing an AI agent, like what was their AI strategy? Were they just doing a co-pilot or were they doing an AI agent, right? And so, one of the interesting things was, you had like the firms that have the data are best postured to develop agents because the data is already there, right? So you have data on like Salesforce. And so if Salesforce could create an agent that does work for you, that's how they should position itself. Instead, they've got Einstein, which is good. It uses AI and machine learning to tell you, which lead to hit, but it doesn't hit the lead for you, right? So guess what? Okay, additional context. Salespeople hate to use Salesforce. They use other tools like Gong or Outreach or a variety. There's like a whole 30 other apps that salespeople, account executives are using to actually manage their sales cycle. And so those companies, so the Outreach is a very popular Salesforce add-in, and it's like everyone uses it to like create a sequence that they then, that has to integrate with Salesforce, but people hate to touch Salesforce itself. And so one of the founders of Outreach actually started this agentic AI business, which is an SDR. It's a sales development rep that is plugged into LinkedIn in Apollo, and it will go through it. You give it your parameters, you give it a persona, it'll go and it'll do the research across those massive databases, spend the time, go through this whole process. It'll even demo your product. Like it's freaking crazy, what these things could have already been able to do, about 5 months ago, right? So I think that this use case becomes actually like a big threat for incumbents like Salesforce. Until Salesforce switches gears and adopts the strategy too, which I think is problematic, and I don't think that they'll be able to make. Um, I think it's one of the easiest targets because everyone needs, like Salesforce is so needed. Everyone needs a tool to help manage the sales cycle, but everyone needs a salesperson. So like this is the tool of the salesperson. If you can just integrate the two, you know, you're done. So I think that that's a huge threat for Salesforce. It's behind my short thesis on the stock. So that I'm speaking my book a little, but so this dynamic that's playing out, use cases are picking up. We're going to see more and more of this, but the thing is that each workflow for every company is a little different, so they need to go through a process to develop that. But as we get these commercial agents that come out, right, that are already out, but as this becomes more commercialized, then I think there's going to be more and more pressure because companies are going to be able to win. Like these new AI tools, these AI agents are not competing for IT budgets. They're going to compete for SG&A, for operating expense budgets. It's a game changer. I think it's huge. And companies like Klarna that figure it out and adopt the technology are going to save hundreds of millions to billions of dollars, every year. So, and they're going to get rewarded for doing that. So I think that is a really big catalyst, and I think that for sure is coming. Is AI going to change the world? It's going to change. It's going to lift a lot of companies for sure. The ones that adopt it successfully. Whether it's going to do, whether it's going to mean that we all live in, a paradise, that's a different story. But I'm so bullish on like the use case and the technology there. So that's the enterprise timeline. So Q1 of next year is when I'm going to really look for guidance around that. And because enterprise adoption is not picked up, I don't expect inferencing demand to pick up from the enterprise side as well. So because people are still testing and playing around with things, right? So the primary use for GPUs right now is still the training side and that early model development. It hasn't switched over to inference yet. That will start to pick up in Q1 of next year as that adoption starts to take place. The other thing too is that, like Microsoft. Okay, so Microsoft has like 300 million, commercial, Microsoft 365 users, Microsoft Office users, right? That penetration, you get 50 million people that are using Copilot in in Outlook, in Word, in Excel, and all these different tools, that's going to dramatically increase the inferencing demand. Okay, so what I think is going to happen is, so, you mentioned that like hyperscalers are like locking up all these GPUs. Like Microsoft in particular needs to do this because unlike say Amazon, and similar to Google, but not necessarily like Google, Microsoft has an existing business that has a massive amount of computing demand, and Amazon does too. That's how they started the AWS business, because they had Amazon.com, right? They're the book selling e-commerce platform. But the thing is that the way that you use Amazon, similarly to the way that you use Google, is mainly search based, whereas the way that you use Microsoft is like you're creating or drafting documents, so on and so forth, right? Or like Microsoft Office. So I think that the differences in those drivers mean that Microsoft naturally has a greater organic compute demand on the GPU side than say Google and AWS. So I actually think that what's going to happen is, yeah, AWS, Google, I'm not so sure, but AWS for sure is probably where down the line people will then have to move their workloads to, because Microsoft is probably going to get a bit more expensive because it has its own demand that it needs to satisfy, right? Like it's its own biggest customer. So I think that's and the and in the AI space, it's its own biggest customer. I think for Amazon, it's not its for AWS. Amazon is not its biggest customer, in the AI space. So I think that's going to be a kind of a key differentiator. I think that also means that and Microsoft and AWS, they kind of compete head to head, but they don't really compete over the same type of customers, right? It's like a different type of a customer. Like you learn about AWS when you're in a software engineering class at Stanford. You know that like, okay, that's what I'm going to build my stack on. You don't really learn about like Azure. But if you're like a corporate executive, right, you're like, okay, well, I need to shift my stuff to the cloud. And so I think Microsoft is going to continue to win from that digital transformation, but that's going to be a key differentiator. Okay, let's talk about consumer though. Okay, so that's the other big AI tailwind. So the tailwind for consumer is that hardware is the challenge, right? We don't have the hardware to run all of these great, amazing apps constantly all the time. I love ChatGPT for Omni. I love that it's multimodal. I love to talk to it. I think it's so cool. I want to just be able to like sit on my computer and be like, hey, can you pull up this file? Can you do this? Like, that'd be incredible. Like, I can't wait for that, right? That's not on Windows yet. Okay. I think they have a version on Mac. I haven't, I've heard good things about it, but I can't wait for that Windows application. They do have an app obviously on the iPhone. Now, this is where Apple's announcement at WWDC was such a game changer, because what they're doing is they're building the consumer case for AI, which no one has really done. Like before, like it was like, yeah, you could use AI to like write something for you, but I mean that's kind of like a low hanging fruit. And we already had tools that could do that. There was like Jasper and other sorts of content creation apps. But in this case, it's like you want to be able to like talk to it. You want it to be able to like do things for you, help you like figure out something. This is a whole new dimension. The way that Apple is doing it too, by making everything in the Apple ecosystem, all the data stays within Apple. Apple maintains control and privacy over it. I think this makes Apple's positioning. Apple has just leapfrogged everyone on the consumer AI space. I really like the
100%.
fact that they're doing like a plug and play, because what this means is they can go to China and they can just plug in Baidu's ChatGPT alternative, or they can Llama 3 or whoever. So they're not locking themselves into one ecosystem. They're being pretty smart about it. So that refresh cycle, we're gonna get the new iPhone next quarter. That's gonna cause a increase in local inferencing demand for these AI, platforms. That's going to increase the adoption, because right now it's like, yeah, I have ChatGPT on my phone, but it's like it's not built in, you could say. So it's not so easy to use. This is now taking ChatGPT or taking an AI into like the operating system layer, right? And so this is going to completely change our relationship with our phones. Like your phone is going to be like what's his name? Jeeves or Jarvis or whatever Iron Man's system was, right?
Yeah.
So that
Yeah.
the ramp is happening, end of this year. Okay. We're gonna get the holiday season. You have Copilot PCs that are being sold too. That's gonna also spur consumer demand for inferencing. So the consumer case is taking off at the end of this year, and we'll start to see it show up in earnings in Q1 of next year. Okay, the first calendar quarter, of next year. And this is gonna be like, so for me, when I think of like the path of like AI adoption, how are all these things gonna feed into like earnings for companies? Like, we're looking at companies now, we're saying, okay, who has the right posture? Who is positioned for this? But really the catalyst is next year's Q1 earnings, or rather their Q4 earnings and the guidance that they get. And so whichever companies are actually building the right types of tools, right, and are actually like positioning themselves to win in this, I think are going to do pretty well. But that's the kind of like roadmap that I've got for how inferencing is going to pick up, where enterprise and consumer is going to interact with existing, supply.
Yeah, we're very aligned on the Apple bull case, by the way, because and I wrote a piece, I mean, if you guys want to read it, about Apple's announcement of something specific called private cloud compute, which they announced at WWDC, and it didn't outside of me, it didn't get a lot of play. But what I think it means is that Apple is to a degree, disintermediating cloud. And so, you guys may know that Apple is a buyer, like they buy plenty of compute infrastructure as a service from Amazon, right? So they don't really want to go into that capital intensive business and compete head to head. So instead, what they're doing is introducing a layer above the infrastructure to disintermediate the direct use, for the developer ecosystem. When I say disintermediate who is the developer? So there, like you were saying about Jarvis, Apple's concept is to treat the device as your constant and ever-present companion that has full awareness of like all the information in your life. And what that means from an infrastructure level is to extend the privacy of your device into the cloud layer. And so they've introduced this private cloud compute. Now, this is particularly interesting because it's fully integrated, or fully vertically integrated. So it uses all the way down to Apple Silicon, right? And part of the difficulty of doing this is like you have to create, you basically have to remove administrative control and access to data, right? So they've designed these computing sleds, using their own silicon, which even they don't have administrative access to. Like, there's no way for a system administrator who's a badged Apple employee with the right clearance to get into the device itself and get access to your data. Okay, the only way to control this server, for example, is a very small API layer that basically has like a few calls, like power on, power off, enter cluster, leave cluster, and that's it. Okay. The code that it runs is all trusted and signed code. So there's code signing, and that whole layer they're releasing as open source and getting third-party audits on, right? So the machine won't run code that isn't signed and verified by an independent third-party auditor vis-a-vis the runtime, where your code runs. And there's a technology in Apple Silicon, which, the technique has been around a while, but I would say that they're perfecting it, called secure enclaves. And what enclaves do is they protect the memory address space and the access to other system resources from other processes running on the system. So this enables them to get sharing of resources and high utilization of resources without compromising the security. There's no way for someone to escape the enclave and get into their enclave and get into your enclave. Like there's hardware partitioning there at the chip level. Okay, so that layer upon layer, there's code signing, there's enclaves, all the way out to like the physical device, all the way out and extending into the network. The same is true of the network devices. Like, there's no way for admins to get in there and snoop data or any of that. So, and the third-party audit and compliance. So what they're doing is creating kind of like an infrastructure shim, if you will, where they can rely on, to a degree, the cloud resources that they use from Amazon. But if you're an Apple developer who's developing like an app for the App Store, and you want to maximize your use of AI and the capabilities that Siri is going to have, or you want to plug into that model ecosystem or the data stream that they're building there, this is like, think of it like it's like App Store 2.0, but it's all on the back end. It's not about productizing front end apps. It's about those front end apps taking advantage of the AI infrastructure in the back end. And so they're creating an entire second ecosystem of app developers that are purely focused on AI infrastructure and code. So, you basically, like, if you're an app developer, your first choice won't be to host your backend on Amazon. Your first choice will be to take advantage of Apple's new, developer APIs, et cetera, that rely on secure, private cloud compute. And that's going to open up the Siri ecosystem to you. So what they've basically done is like shut everyone out in the cloud space. So, it is a very real foray into being an infrastructure as a service, a cloud company, and they're going to monetize those layers. But it's interesting because at the same time it drives utilization to stuff like Amazon, it disintermediates them from the customer. It's really the first strategic genius move that Apple has made since Jobs died, in my opinion. Like, it's the first thing they've done that was like, oh man, someone at Apple still understands strategy somewhere. They've been focused on all the wrong things for the longest time. How many more megapixel cameras can you cram on the, just speeds and feed stuff. This is actual deep tech innovation that not only secures their user base and like provides all these capabilities that, like you're saying, Wahdy, like no one else will have, except of course Google with the Android ecosystem. They'll do the same thing. But to me, it's a big cloud move. So that I think it's the real question mark is, how much do people trust this? Will they adopt it? But I think that they will, because it's just going to be so damn convenient. All the stuff you were talking about, like, having assistants go through your stuff, you're just going to be like, hey, Siri, that email that I sent to Wahdy like 2 weeks ago about such and such, can you like resurrect that and set up a meeting for tomorrow? Like, it'll just do everything that's like cruft in your workflow for you and be your constant companion. So I don't see any way that it doesn't get adopted, because it's just going to make things so much easier.
I'm just going to chime in here on the searching part. I talked about the NVIDIA Chat RTX function. Like, that was a couple of months ago. I try to use it, and then the way they try to do it is like, okay, so if you have an NVIDIA GPU, and if it's you can install this app called Chat RTX onto your PC, and they'll have access to all of your files, and you can ask them questions and get stuff done. Doesn't work. It's just like, it's really good on the YouTube video. It's really good on the website, but I have enough computing power in my RTX.
Why doesn't it work? Why doesn't it work?
It is a very unintuitive app. So it's like almost you're coding this stuff rather than ChatGPT. You can ask the question and it will just pop out. So you've got to like map all of the address, the address of your files. You gotta figure out what it can access, what it cannot access, and then after doing all of that, when it asks you a question, it just said, "I'm sorry, couldn't do it." And I'm like, yeah, I just wasted 2 hours on my life. But this is another kind of attempt at utilizing the GPUs you already have in your computer to do this, searching instead of like outsourcing this to a data center. And obviously, I can see why NVIDIA is doing it. It helps with the hardware sales. So if Apple can do it, like all of the reasons you just listed, James and Mo, I think, yeah, they're in for a very good shot. And you had me laughing at the camera bit, because what's good of like more storage if every picture you take is like 4 times the resolution? You're just gonna eat up all of the storage anyway. Yeah, I agree.
You're exceeding the capabilities of the human eye. I mean,
right? Yeah. Yeah, like 48 megapixel. I don't even have that much pixels in my camera, so yeah.
That makes sense. I'm gonna quickly share just something because one of the things that we've been doing is using my Apple model to kind of help them go through a couple of things. So wanted to give you guys like a little bit of an update here and showing this so that you can try to replicate it on your guys' side. So for so this is the, just as like a walkthrough. This is the actual like model that I've got for Apple. And then these are like the scenarios that I mapped out. We've gone through this, which is the different sell side cases and then some of the metrics. Then I've got a bunch of data that I pulled directly from Visible Alpha. I prefer like Bloomberg is good, but Visible Alpha is it's just the standard. So that's why I use it. Though I would say that Bloomberg is probably still what the majority of people are using. Now, couple of things here. One is when it comes to like the valuations standpoint, analyzing the multiple is always pretty tricky. And the way to understand the multiple, and this is something that I've taught you guys to do, is the best way to understand the multiple is not from the standpoint of like, valuation does not tell you like you don't really go to valuation first. You use valuation to then decompose the metric that the street is betting on, right? So we're always trying to figure out what's the market implying by a multiple at this level. And so this is like my walkthrough of that, of how I did it. So I've got some comps over here. I ended up not using any comps except for the market. And the reason why is because, this is Samsung, for example. Apple really kind of, you know, doesn't have direct comps, from that standpoint. I did try to do like a sum of the parts, but um, it just I think the challenge was there really is just one competitor, that's Samsung, and that the way that they roll or like wrap that business up is just it's a little different. So I thought what was better is I'm going to do the analysis versus the market to give us the like interest rate or like the industry dynamic shift. And then otherwise, I'm going to look at the actual shift in Apple's metrics itself. So over here, what I've done is I'm actually pricing the stock. So this is like my price target builder. This is just like my summary. So this grabs the data that I've got in my model and just presents it in a way that's easy for me to reference against like consensus estimates. So I can see like where's my variance, and see like, okay, I got an upside versus the street. This is how I actually build a price target. How I'm building the price target is on fiscal year 2026 sales. Their fiscal 2026 even EBITDA. And the reason why is because if I look across the street, most of everyone is focused on that year. That's the way to see it, is that like the bet is on, is there going to be like a big upgrade cycle or not? And we're going to know that it's a big upgrade cycle because of the 2-year peak or like the 2-year expansion in iPhone unit shipments. So that is going to be by 2026. And so that's why that's my terminal period. This is my sales estimate for 20. Actually, I need to update this. Yeah, I didn't update it. So these are my estimates for 2026. This is actually pulled from my model based upon my unit shipment forecast and then my margin estimate. And then this is like my the multiple that I'm saying, okay, this is what I think the stock is going to trade at. And when I analyze the multiple, yeah, I'm going to do something like this. Like I'm going to look at how the multiple has traded. And I think I walked you guys through this the other day, but it's trading above that. So so there's definitely some space. I'm at 22.5, a little lower than we are today, give myself some margin of safety. I get to a price target of around 265, to 270. The way that I break this down is I'm going to look at this is the current consensus. This is Visible Alpha consensus EBITDA, and the EV to EBITDA on Visible Alpha consensus is 22.9. My view EBITDA is almost 180 billion by 2026, which means that the multiple for me is trading at less than 20. Okay, it's at 19.2. So it's actually pretty cheap relative to where consensus is. Now, market implied. This is what matters. Okay, what is the market pricing today? The market seems to be applying 165 billion. So the multiple that the market is trading on is roughly about 20.8 times. So this is like the positioning, right? So this is people's expectation. I have a delta in the metric between my view and the market of about 8%. So I think that there's still 8% upside to just, even if the multiple does nothing, it just stays flat. I think there's upside of about 8% just from the delta in the EBITDA, perspective. So that's kind of the way that this works. And then yesterday we were talking about how like, the ultimately you want to get to like how to just shift my fair value estimate. And that's going to be now that I have like what my price target is, and I know what the price targets for the different scenarios are. Okay, these are the different scenarios, and this is their price targets. Now I can say, well, what scenario is more likely? And we were talking about this the other day, which is now if I see that there's more visibility for my scenario, I can lift this. I can say, okay, this is 85. This is 10, and there's like a 5% chance that I could be very wrong, and I can see how that's going to lift my fair value estimate. You kind of expect that the price is going to move in the direction of your fair value estimate, and the shifts in your probabilities are going to always happen when you get new incremental information. So this is why it's kind of like if you think from a Bayesian standpoint, you got your prior view, then you get new information, you shift to posterior view. That should lead to a change in the stock price. So this is the mechanism that helps me kind of evaluate this. You guys should definitely build this into your models as well. Now, the thing I think you guys we've already got through this stuff ad nauseum, so you guys are probably already here. But what's going to help you guys is I built out this scenario or this like market implied scenario or like a market implied table to help you get to that implied level, right? What is the implied metric, right? And so I watched you guys like how I do this, right? Which is you take a look at what was the metric. So the last informational event was the WDC, event. So I put that so I'm taking the estimate as of June 6th, 2024. And I'm saying, okay, what was the multiple that day? And what is the current multiple? And the change in multiple, okay, means that like that's the market. That's consensus hasn't lifted by 16%. Consensus has only moved by 1.1%. Okay. So what is the change in the multiple? That's 16%. If I take this and if I subtract the metric move and I also subtract the market's move, because that's maybe a view on interest rates or so on and so forth, I get to like what the ideo specific move of what's the market implying at this level of multiple. And that comes down to around 467 billion by 2025. And in 2026, it's 45 billion. Okay. Then what I do is I look at what my forecast for the percentage of iPhone sales are for those periods and what the consensus unit ASP is. And that gives you what the implied units are. So I know that now the market at this level is pricing in about 270 million units of iPhones shipped in 2025 and almost 280 million in 2026. The total amount of of units that are going to be shipped in over the next 2 years based upon the market implied is around 550 million units. Consensus right now is at 474, right? So it's about 75 million below. So, or rather, the market is pricing 75 million more units to be sold over the next 2 years than consensus is. Okay. That's the bear case. This is my view, and this is the bull case scenario. So this is how, like all of this, now I can really make an assessment as to like what I think is happening here. Is this reasonable or not? And so obviously for me, I'm like, well, is there more material upside? What does this mean? And so I made this is just like an ad hoc thing, which was, okay, what is the growth rate implied? And that's about a 40% increase in unit sales through the upgrade cycle. And I think I walked you guys through how historically, we would have periods of unit sales that could increase, that much over like a 2 year or 3 year ramp period, right? And so depending on like what the new product cycle was, so everyone always points to like the iPhone 6 as being like a really big step up in units. That drove almost a 50% change in unit growth over a 2 year period. The other one was, in 2021, they had that big upgrade cycle. That was almost a 40% unit upgrade cycle. And so, the question is what's going to happen now? For me, I'm putting it at like 26%. So that's pretty low, right? Like that's not as crazy as it was previously. If I lifted mine to be more in line with those major step ups, then that would give me material upside, I think. And so I think that I can understand what the market is pricing in here. Now what the market is saying, hey, we think that there's going to be that 40% increase in and unit growth. And I'm like, maybe a little under that. So that's the dynamic here that I've got. And so this walkthrough I think is going to be super helpful to you guys because one of the challenges is like, well, we want to know like what is the period that we need to make the assessment on or make the change on. How do we do the analysis? How to make any adjustments? So I kind of walk through like all of this stuff here and explain, what's happening. So that way you guys can kind of follow along. So you could even like, I don't want to say you could copy and paste this over, but just it's just a simple setup. And then if you get, you just walk through this. Now the key thing you always have to remember about is getting like the date right is very important. You need to know like what is the period that you need to do the reference on, and you pretty much want to make the reference on. You can't use like blended or like NTM forecast salary. You got to use like the fiscal year just because of how the data rolls. And so, you kind of want to break it up into two different fiscal years. And then also, if there's a new information event that comes out, like say earnings, I'm going to update this and see what the change is and then, go from there as well. So this is what that process looks like. It should be pretty familiar because we talk about this a lot and I do it on the fly. And I think sometimes that's helpful, but sometimes it might confuse people. But this is like, okay, mechanically like broken down. This is how I can take a look at how the multiple has expanded and what that expanded multiple actually means that the market is implying on a unit cell basis, right? That's how to use valuation. That's how valuation is super useful because I can say, okay, well, that's kind of consistent there. When I go back and say, well, what's the stock going to trade on? Currently, the stock is trading on 22.9 times. Okay, so I can just take the current market, multiple and price my EBITDA estimate on that. And so this is like the useful thing. So I know that on my multiple, the market is still pretty low. Like we can still move a little higher. So these are the bit of the dynamics that I just wanted to walk you guys through. Full integration of how you would take the changes in the multiples, use that to help you figure out what the implied metric is, and then in this case, I'm going it down to the unit sales, right, for iPhones, and then over here, and when I'm pricing it, okay, I'm taking that information. I can just use what the current multiple is, or I can give it a slight discount. Just depends on where I think the range is and how we're trading within the range. But can start with the current multiple and just price my EBITDA on that. And then I can also take a look at, okay, well, based upon the different scenarios that I've outlined already, I've already done the work in the scenarios to lay them out over here, based upon the scrubbing that I've done of sell side research and their analysis. I can then say, well, based upon new information, if something shifts, this is what I'm going to expect the stock to trade up to. Like, it should trade up to this, like in the real near term. Now, if it's like an earnings event, right, and I know that this is the catalyst that everyone is waiting for, this is it. Well, in that scenario, right, that's going to be, I think that there's going to be 100% of something that's happening. But I normally won't assign this or do this until like the day before earnings. Everything before then needs to be kind of adjusted also by like the time, that it takes. And, again, typically the way that you should see it is that the stock price should always trade. Your initial like point is that the stock should trade at the midpoint between the two most likely scenarios that are embedded, right? Because everyone, all of the buy side and long onlys, mutual funds, hedge funds, they're all reading the same equity research, right? And so, and they're generally gonna like agree or disagree. And by the way, sell side research analysts, they talk to the PMs, they talk to the buy side analysts. So there's a lot of congruence in views there. And so this is a good way to kind of start off by thinking about, okay, what is implied in the current price? What are the scenarios that are being priced in right now? And then where do I think it's going to go, given my view of what the terminal or what the actual outcome is going to look like. But again, should never be 100% until you're like a day from earnings or like the day of earnings. And the reason why is because, up until you get to, the outcome, the initial basis distribution is going to be like a 50-50. So that's just the way that, I would suggest thinking about it as we kind of move through time. Any questions on the setup though?
I'm gonna have to play this back a couple times. Then I'll see if I have questions.
All right.
I think as an earning coming up, this is like super helpful. Like not doing it way ahead of time, and always calibrate it. By the end, yeah. I think it helps with my model building side. So
Right. And this is the thing that's good. So you're going to have like an investment decision based upon this. This is like,
yeah,
I want to be long or short the stock. And then this is your trading, like, okay, I want to buy it right now, or should I wait a little? What do I think? When do I think the information will come out that would shift the weights? That's what we're hunting for, from a catalyst standpoint.
Yeah.
Cool. All right, guys. Well, I think we're running a little over, so we'll go ahead and wrap up here. Any final questions before we end for the day?
Just again, don't know what's gonna happen tomorrow. Yeah. Yeah, we'll see. We'll see how it goes, and probably catch you guys in the chats if anything pops up.
Sounds good.
Oh,
Yeah,
what
great
was the
session,
chat that
Bills.
you guys are in, by the way? Is it on IB?
Which one?
Like the one that you and James are in?
It's a Telegram chat. We should add you to it.
Oh, Telegram. Okay.
Yeah.
I think I need to figure out an account for it. I might not
Alright.
have it. I'm a text person,
There you go.
All right. Okay. Cool. Oh, that's all for me.
All right, cool.
So
James, thanks again for hopping on today.
Oh yeah, is this a daily call, by the way?
Yeah, we do this daily.
Okay. I'll try to be here daily. I may have some days when I can't make it, but I'll try to attend as many as I can.
All right, cool.
Oh, I mean,
All right,
more
guys.
pressure for me to deliver, right?
There we go.
All right, nice meeting you. Thanks.
Nice to meet you too.
Yeah.
Looking forward to this. So I'll see you guys tomorrow.
Cool. Yeah.
All right.
See you tomorrow.
Take care, guys.
Bye.
Bye.
Bye. Thanks.